Good morning, friends. So we are starting our today's second session, or rather second day of our refresher course. However, before we start it, let us all get attentive to our institute motto. Mr. Raji, can you please start our institute motto? Mr. Raji?
2 seconds से play करो 2 seconds.
Sure.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यति कश्चन एतद्द्वैता 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 एतद्द्वैता.
Okay, so starting with the second day, friends, just to recap, yesterday what we took away was the digitalization, a simple concept which we always felt that technical know-how or anything relating to technology, what has to be paid is royalty. But then we saw the equalization levy coming on advertising, then the online purchase and sales, and then we moved to pillar 1 and pillar 2, which is entirely changing the taxing rights. Now, this particular factor has been going on, but on top of it, the pandemic has actually brought a fast pace to our digitalization. In fact, to tell in a simple word, God has pressed a reset button after the pandemic. And that reset button has actually changed everything, including our international tax, the way we are working, the way the transfer pricing is going to happen. And definitely, the changes are far-reaching. We never thought that we will be having such type of sessions online, but that has all changed. The way you are going to tax the income that I'm going from the institute, we have participants today right from UAE to Australia on this session. So you can imagine who is going to tax that income, which is going to sit in India's books right now, but the revenue is flowing from Australia and UAE. So these are all the complications which are now coming up in transfer pricing world as well. And who can be a better person than a transfer pricing veteran like Mr. Waman Kale, who is with us today. We all know Mr. Waman for last 20+ years. So really he doesn't require any introduction, but just for the benefit of the new members, Mr. Waman Kale has an experience of 24+ years. He is also, along with the Institute of Chartered Accountant, a member of also the Institute of Chartered Accountant of England and Wales. He's a partner in BSR and Company, and he specializes and has extensive knowledge in transfer pricing, right from your basic planning up to the highest level of litigation of APAs and MAPs. You name it, anything on transfer pricing, he has solutions for everything. So with that brief introduction, let me welcome Mr. Waman Kale to our session to share as to how this pandemic has actually changed the way we need to now reset ourselves. Over to you, Mr. Kale.
Very good morning to fellow members, and firstly, thank you, Rakesh ji, for a very kind introduction. It's always a privilege to be invited by one's alma mater, and I'm really appreciative of being here today.
You're welcome, sir.
I will just share my screen. Okay. So as I was reflecting on the topic that was assigned to me, that is transfer pricing, looking at it from a pre and post pandemic lens, I really saw this as a wider discussion than only talking about what are the challenges that taxpayers are going to face during the assessments of these pandemic affected years. The way I see it, this period can in fact be looked at as a sort of a watershed, a sort of turning point for us as practitioners, taxpayers, as well as the revenue, to really take a fresh look at how we approach transfer pricing. Turning to the next slide, let's take a trip down memory lane to 2001. That's when transfer pricing provisions were enacted. Now, as you will see from this chart, this period has coincided with the most incredible growth story for the Indian economy. From a GDP of around 470 odd million in the year 2000, today we are around 2.7 trillion USD, and hopefully headed towards the aspirational 5 trillion vision laid out by Honorable Prime Minister. Now, this track record of growth, this has somewhat influenced how transfer pricing has been historically approached. That is, there has always been an expectation of profits, and not only that, an expectation of a year-on-year growth in the profits, in line with the fact that even companies were making more money. Now, if you also see during the past 2 decades, that is prior to the present COVID-related economic fallout, the world economy has witnessed 2 major economic shocks. The first one, the dot-com bust, which was thereafter followed by the 9/11 terror attacks. And the second one in 2008, which was the financial crisis brought about by the collapse of Lehman Brothers and other leading financial institutions. Now, while the dot-com and the 9/11 shocks were in the early days as far as we were concerned, so far as 2008 credit crisis, India was largely insulated. So as a result, from a transfer pricing purposes, we have never really had to grapple with the impact of any significant economic downturn so far. And if you see, as a matter of fact, the remuneration models of most multinationals, they are based on an expectation of a profitable outcome when they are typically when they're dealing with a country like India. Now, as a transfer pricing practitioner, it is very common for me to get questions like, there is a new transaction, can you give me a benchmark for it? Or what should be the margin for this? And again, while these are admittedly valid questions, they also represent a larger underlying problem. Transfer pricing is so much more than just benchmarking and margins. And this pandemic offers us an opportunity to approach this subject with a fresh perspective. Now, since the theme of these sessions is a refresher course on international tax, let me begin with a brief summary of the key provisions and pronouncements that are relevant for this subject. So the relevant provisions are contained in Chapter 10 of the Act, Section 92 to 92F. These are the substantive provisions. And you have rules, the 10A to 10 THD. These are the relevant rules. The scope is basically, the charging provision, so to speak, is that any income arising from an international transaction shall be computed having regard to the arm's length price. Then we have fairly wide definitions of what constitute international transactions. And there was an amendment. It was a retrospective amendment that was brought out by Finance Act 2012, which significantly expanded the definition of what constitutes international transaction. We also have the concept of deemed international transaction, which is anti-abuse provision, and the concept of specified domestic transactions. So certain domestic transactions are also subject to the arm's length requirements. Then Section 92C that deals with the determination of arm's length price and the selection of the most appropriate method. So we have 5 prescribed methods plus a residuary 6th method, and we have the concept of most appropriate method, and this is in many ways the heart of the subject. Then there are requirements for the obligations from the taxpayer to maintain mandatory documentation, which is contained in Section 92D read with Rule 10D. And for larger taxpayers, there are requirements to prepare a master file. Then there are reporting requirements, the accountant's report required by Section 92E in form number 3CED. And there are certain other requirements like for larger taxpayers, like country by country reporting and so on. Then dealing with assessments, the reference to the transfer pricing officer, Section 92CA, that is a scheme of assessment where transfer pricing is involved. And there is an instruction number 3 issued in 2016. This is important. Instruction number 3 of 2016, which governs the relationship between the AO and the TPO. What is the domain of the AO? What is the domain of the TPO? All that is explained very well in the instruction number 3 of 2016. Then we have penalty provisions, which I have stated. Some of the most draconian ones are relating to the failure to maintain documentation, which attracts a 2% penalty, 2% of value of the transaction. Similarly, there is a penalty for failure to report the transaction, which again is a 2% of the value of transaction, which are fairly stringent penalties. Then the next 2 points, which we have advanced pricing agreement and safe harbors. These were mechanisms introduced by the government to try and reduce the litigation for taxpayers. The advanced pricing agreement program is something which has seen a very overwhelming response, and a large number of advanced pricing agreements have been concluded. So clearly a success story. Safe harbor has probably not seen as much of an adoption, but it's clearly an option that is available. The other points of reference, there are one of the important circulars that I would like to mention is circular number 6, which is we commonly refer to it as the R&D circular, which is very relevant from a practitioner's perspective. And then, of course, last but not the least, the ICAI has issued a guidance note on the accountant's report under 92E. The last revised guidance note is 2020, which of course all of us as practitioners should be aware of. Now, as we emerge from the pandemic, one of the key concerns is going to be for government is on the fiscal deficit. And the concern which is relevant for the topic of our discussion is what impact will this have, that is the need for additional tax revenue, what impact is this going to have on transfer pricing assessments going forward? Now, in particular, the real concern is that is transfer pricing, will it be looked at as a low-hanging fruit or an easy target? And for this, we can maybe look at the past, and if we see I've got presented some statistics over here. I'm not getting into the statistics, but basically suffice it to say that if you look at any parameter like cases selected for scrutiny or the number of adjustments made or the value of adjustments made, it's been very large. And among countries around the world, India is today, we probably have the largest preponderance of TP disputes. Certainly, we have the largest body of jurisprudence anywhere in the world on transfer pricing. And I think important point for us to note is that this is a economic law, and therefore there is a inherent amount of subjectivity in this. And also it is very, very fact specific that lends itself to a lot of dispute, especially in the environment, in the tax environment that we deal with. Now, governments around the world, it's again not only an India issue. Given this is an area of priority for governments across the world, and there is clearly a risk of economic double taxation because different governments are likely to take a protective stance towards their own country's tax base, and accordingly there are likely to be disputes, and even more so in the pandemic years when all governments are going to be looking for increasing their tax revenues in order to be able to fund various relief measures and projects that they are undertaking. So now with this, we will move on to, in the next few slides, we will go over the main principles that we need to follow when analyzing the impact that the pandemic has on a transfer pricing analysis. Now, when we look at the impact on any business, this really should be viewed at three levels. Whether there has been any change in the business model, whether there is any change in the overall business environment or business conditions, and finally, is there any possibility of exploring any planning opportunity? So let's start with the first question. So has the business model changed? And I think the answer in a lot of cases is going to be obvious. And as Rakesh ji said in the opening, look at what we are doing right now. Take the webinar. Something which in a normal course 2 years back, we would have probably been in some conference room having this as an in-person discussion. Today, we are doing it in the comfort of our own home. And as Rakesh ji mentioned, people around the world are able to participate in it. So clearly, there are lots, this is an example, there are lots of industries where the virtual way of working has completely changed and altered the business model. So which means that in a lot of these cases, there is a need to have a different or a new transfer pricing policy. The second question that we have to look at is, has the business environment or business conditions, have they changed? And again, there will be a lot of industries which you will see where, yes, it has significantly affected their ability to conduct business the way they were doing it. Take the example of, let's say, cruise lines. Take the example of, in general, of the travel industry, the airlines. The impact has been significant. The business environment and conditions have changed. So which means that whatever policies that they had in place, they will need to review that. They will need to review the existing policy and make necessary changes to give effect to whatever new conditions that they are dealing with. And then finally, as a result of all these changes, is there a possibility for any planning? And yes, there will be changes in, as I said, changes in the delivery models, changes in supply chains, and that will give an opportunity to organizations to maybe do some planning and reorganize in a manner which may be more tax efficient. So given that it is almost a certainty that transfer pricing models for most businesses will have to be revisited, so what are some of the guiding principles that one would need to be mindful of when attempting any change in a transfer pricing policy? I think the first thing to remember is that the there is no assumption. One should avoid any assumption that there is going to be a change. Now, there is possible there may be a change, but it is not a certainty. So first thing to avoid is any kind of an assumption that there has to be some COVID adjustment. There could be, but there may not be. And that leads you to the next question as to what is the economic story. So is it something, is your business, is your industry affected enough for you to be able to justify some change or some adjustment on account of COVID? Now, today, a classic example is IT services. While a lot of industries would have suffered, if you look at IT services, that has been the backbone of most businesses, and therefore the IT sector has actually done very well. So it's very important for us to understand what is the economic story for the particular business that we are looking at before we go ahead and make any kind of adjustments. The next is the review of existing contractual arrangements and allocation of risks. So does it support any such change? So if today, if the contract is structured in a manner that one entity is a risk-bearing entity, the other entity is not a risk-bearing entity, then within the existing construct, can you simply do a reallocation of risks? That needs to be seen. And again, when which entity should be bearing risk or should not be bearing risk, it's not a question of just simply changing a contract. It is, the larger issues are whether the entity that is going to bear the risk, whether that entity is capable of performing the functions necessary to exercise control over that risk, and does the entity have the necessary capital to bear the fallout of that risk? So these are very important points. So merely changing an intercompany contract is not enough. There has to be something more. Then there are certain factors, especially in the pandemic time, which would be, one-time things which are beyond the control. And now, how do you deal with some of these things? So one of the theories being put forward is bargaining theory, which is, frankly, it just means that, okay, how would a third party deal with it? And I don't really see this as different from the normal arm's length principle. But to the extent that if there is any evidence of a dealing with an actual third party, so if you are dealing with a customer or a supplier, which is a third party, and certain things has been agreed to, that could be evidence of something that can be implemented in a related party setting as well. Finally, is there any guidance? So India has not really come out with any guidance as far as what kind of steps need to be taken or what kind of adjustments are permissible during COVID times. So there are some countries which have come out with guidance. The OECD has also come out with some guidance dealing with comparability issues, dealing with treatment of losses, government grants, and advanced pricing agreements. So as I'm not getting into the technical part of it, but as we go along, we will discuss the relevant principles. Now, whatever analysis is done, it can basically lead to two possibilities. Whatever conclusions, we can have two possibilities. The first is there is no change in methodology, or another possibility is that the methodology is going to change. So let's first deal with the first possibility, that there is no change in the methodology. Now, even if the methodology remains the same, and of course, we will have to confirm that with reference to the undertaking an industry analysis and looking at the business. But even if you confirm that the method is unchanged, there may still be a possibility to look at making certain adjustments for items like any extraordinary or exceptional items which have come about. So they could be both embedded in the transaction if you're using in a transaction value, or if when we say tested party, you're really looking at the profitability. So is there anything which is exceptional, any exceptional cost which is specific to this COVID period, for which some adjustment needs to be made? Is there any something like a capacity underutilization? Is it possible to make an adjustment for that? These are some of the things that could be looked at. Then revisiting a comparable search. Now, when we talk about comparable search, we're essentially talking about a profit-based method. But in the past, and we talk about quantitative and qualitative filters. So basically, this is the process in which a search is carried out, and you apply certain screens and filters to finally arrive at a set of or the data set which is finally used as the comparables. Now, in the past, it was generally customary to reject companies which were perpetually loss-making companies. Now, given the fact that we are in a pandemic situation, while in a normal year, it would have been all fair and proper to reject companies which are loss-making companies, maybe this is something that needs to be revisited in times such as this, and perhaps it would be appropriate to retain some of these loss-making companies in arriving at the final data set. Now, even within the same methodology, so we are assuming the method is unchanged, other tweaks that also may be considered is, are you looking at the correct segment? Again, looking at it from a profitability perspective, are you looking at the correct segment? Is a further segmentation possible? So I'll give you an example, and I've got a slide later on in the presentation on this, that if you take ITES or back office ITES services, generally it is in any transfer pricing analysis, we typically look at back office or ITES as sort of one category of services. Now, if you see during these times, specific verticals of ITES, so be it hospitality, BFSI, different verticals have had different results depending on how the businesses themselves have performed. So, because unlike IT services, which is more of software, the ITES is more linked to business activity, and depending on how well or badly the business has done, the ITES industry in some way has reflected that, and that is quite visible in the way margins have moved in the in individual business segments of the ITES industry. And I've got a slide later on which we will deal with. So basically, point here is that, is it possible to look at the segmentation in a different manner? Second is the tested party. So tested party, the concept, I'm sure everyone's aware of it, that which of the two counterparties in the transaction do you test? And generally the principle followed is that you test whichever is the simpler of the two entities. So again, there could be some change in terms of, looking at testing either of the two parties or doing a corroborative testing. So there could be some possibilities over here. Reconsidering the testing period. Now, of course, the normal default position is that you look at the financial year, but given this COVID time, can you break that down into smaller elements? So let's take this current financial year, 21-22. The first 3 months could have seen the impact of the second wave and lockdowns and so on. And maybe the rest of the year will be different. So is it possible for us to look at quarterly data, finding comparables on a quarterly basis, looking at quarterly data rather than looking at the whole year in aggregate? This could be a possibility. Finally, the issue with single year data. Now, again, I will have to slightly go back into the history because this is now a practical challenge. The long-standing demand of taxpayers had been to allow the use of multiple year data, and it was the department who would push back and say, no, the law only talks about single year data, and therefore you're not allowed to use multiple year data. So basically, multiple year data means that when you're doing any calculating, let's say the margin of a comparable, you not only use the data of the relevant previous year, but you take the data of the 2 preceding years and take a weighted average of the 3 years. Now, think about the impact that this is going to have in the COVID time. In the COVID time, if you have the data of 2 preceding years, so you have, let's say, financial year 18-19 and 19-20, which are non-COVID years, and 2021 is the COVID year. So if you take a weighted average, you will have the COVID year, which has a loss potentially, and the earlier 2 years which have a profit. And you will have to compare this with the taxpayer's result. So in an ideal situation, you would have wanted to compare the taxpayer's result, which for a COVID year, with a like-to-like comparison of another COVID year. Unfortunately, the law requires you to take a 3-year weighted average. And this is going to be a real practical issue when, and you know, hopefully there will be some guidance coming out. But other than that, this is a very practical issue to dealing with how do you get out of dealing with weighted average and try and use single year data. So a very practical problem that we will have to deal with. Now let's come to a situation where the methodology has undergone a change. Now here there will be a much greater need to exercise caution because a change in TP methodology, especially in a year which is a COVID year, is likely to be challenged. Now what you need to have is there has to be a credible justification for a change. Let me give an example. So unavailability of comparable data. So let's say, for example, that a taxpayer has historically had a significant amount of third-party business. But because of the changed circumstances during this year, there is very little third-party business. So the comparable that was historically being used, which was dealing with another third party, that no longer exists. Yes, there is a reason to follow a different methodology. The other issue is what we call a survivor bias. This is a practical problem. When you are using a profit-based method in a period like this, the companies, there are a lot of companies that are going to go out of business. The loss makers, they will go out of business, or the low profit making companies may become loss making companies, go out of business. And the companies that remain, they are going to make more money. So this kind of a survivor bias means that the companies that you will get as comparable are the ones that have actually survived, and by implication, they are the stronger companies and making more money. So this is actually skewing the result. And this will pose a practical problem, and therefore there may be need to look at a different approach. Finally, is there any change in what we call FAR? So FAR is a technical term for functions, assets, risks. So is there any change in the FAR as a result of the pandemic? And yes, if there is a genuine change in the FAR, clearly that is something that could be justifiable. But I think very important that if there is a change, one should expect a challenge from the revenue, because they will certainly regard it as something which is opportunistic because of the pandemic period, and the genuineness would really have to be substantiated. So again, as mentioned earlier, so the revenue challenge can be expected, and especially if the policies are such that they provide low profits in a stronger economic environment, and then you change it to say that when the economic environment is challenged, you should be sharing losses. This can be a problem. So let's say you have a historical cost plus model, and in a pandemic year, you say that now it's no longer a cost plus. Now I'm going to change it to a per hour billing model. It's something that is likely to get challenged. And more importantly, it could also be seen potentially as a transfer pricing manipulation. So potentially even a penalty exposure cannot be ruled out. An important point is, okay, what happens when the economy recovers? Is it really a short-term change that you're looking at as a more of a quick fix? And what is going to be the ramification for the future year? So any kind of change that is being considered, wherever the methodology is going to be changed, not only is it important to consider the future years, equally important to consider what positions have been taken in the past years, because this could have a ramification for open assessments and potentially have an exposure for reopening as well. So any change should be very, very carefully considered. Now we move on to examine some practical scenarios. So we have taken 3 relatively simple case studies, and these are likely situations that could be expected practically. And we will analyze what are the principles that need to be applied and how these issues need to be dealt with. So we'll start with these case studies. So the first case study we have, that is involving a manufacturer and a distributor. So briefly, the facts of the case are as follows. You have FCO, which is a manufacturer in country A. ICO is a limited risk distributor in country B. The historical TP policy that is being followed is that the LRD, or the limited risk distributor, is remunerated with a 2% operating margin. So which means operating profit divided by sales of the distributor should be 2%. This is the policy that has been followed. Now, during the pandemic, there is a significant decline in sales and several exceptional costs have been incurred both by manufacturer as well as the limited risk distributor. But the manufacturer continues to compensate the limited risk distributor in line with and as required by the historical TP policy. So limited risk distributor continues to get 2%, and while the group is loss making, because the LRD continues to have a 2% profit, the group will have a tax payout. So in this slide, you will see a hypothetical financial for this group. So as you will observe, combined group has a loss of 40, but distributor has a profit of 20, which is the 2% operating margin. And therefore, the group as a whole pays a tax of 6 despite having an overall loss. Now, this kind of example that we just saw, this is typical for many taxpayers due to the historical policies that the way the TP policies have historically been set up by the group. This is very typical. Now, the questions that we need to answer is, can the historical policy be modified without any change to the FAR? The second is, does the return for routine functions and risks? So here we are assuming that this is a limited risk distributor. So the question is that, does the return for these kinds of functions, which are considered routine functions, does it always have to be a positive return? And the third question is that, what if the risk profile of the limited risk distributor has changed during this current economic environment? What could be the implications of that? Now, here we have presented in this slide, we have presented the first solution that is possible. Now, in this case, the solution is that without changing any functions, here you are reducing the limited risk distributor's target operating margin to a lower point in the benchmark range. Now, as we are all aware, the law allows us to use a range when there are more than 6 or more comparables. It is possible to use an arm's length range, which runs from the 35th percentile to the 65th percentile. Now, what the proposition here is that you lower the operating margin of the limited risk distributor to the level which is at the 35th percentile. And let's assume that this reduction leads to a margin of operating margin of 1%. So here, here you will see that the limited risk distributor, the profit goes down to 10, and therefore the tax at a group level is going down. So to that extent, there is a immediate saving of cash without a very significant change in the TP risk being undertaken. Okay. Now we have an alternate solution here, that is it possible to have a break-even or a loss-making position for the limited risk distributor? And here the important point is that will this be continued? So if you are giving a lower profit or asking the limited risk distributor to take a break-even or potentially a loss, will the profit of the limited risk distributor increase in a symmetric manner in the upturns? So again, one has to be consistent. You cannot have a situation where you will only make the distributor share in a loss here and then not give the distributor an upside. So again, this would involve a risk if it is being implemented in a current kind of situation, unless there is a clear evidence to show that that this kind of approach has been symmetrical and the LRD, limited risk distributor, has received a higher share of the profit in good years. The next solution, or the third alternative we are looking at, is this is something that might involve a greater amount of challenge. So here you are recharacterizing the limited risk distributor as an entrepreneur. Now, this could be feasible if, again, it has to be supported by the fact pattern. Now, if it is the case that because of the pandemic situation, a decision has been taken to delegate greater amount of authority at a local level, because you need to be more nimble-footed, you need to have a greater understanding of what is happening on the market, and therefore a greater amount of decision-making has been devolved onto the local distributor entity. That would have to be the kind of change of functions that would be necessary to support this thing. Again, the decisions relating to marketing activities, the decisions relating to taking customer credit decisions, these are all decisions which would have to be taken locally. And again, the local entity would need to have the necessary functions and the people functions who are capable of taking these decisions, and also a sufficient amount of capital to be able to bear the risks of any fallout of these decisions. Again, I would just make a reference here to the BEPS action plan. So BEPS action plan 8 to 10, which contains a lot of guidance on the allocation of risks between contracting entities. And I think it's a very, very useful document for making any reference. And also in these situations, it's very important to take into consideration what could be the impact of this on past positions. So that takes us to the next case study. And this is in relation to a captive service provider entity. And these are very common situations that we encounter. So the facts of the case are: ICO is a limited risk captive entity engaged in providing IT or ITES services on a cost plus basis. The pandemic has adversely impacted the FCO, which is the company to whom ICO provides services, and it has resulted in a significant drop in their revenues and a lower economic activity. As a result, the volume of work being outsourced to ICO has dropped, and the ability of FCO to pay has also significantly reduced. And meanwhile, ICO has had to make investments to facilitate the remote working of employees. Now, what are some of the challenges that ICO can face in this kind of situation? So idle capacity is one of the foremost. You have offices that would be lying vacant. You have less amount of work that is getting offshore to India. Then there would be exceptional one-time kind of costs which are incurred to enable the staff uh, to perform their activities from home. So the work from home related costs. There would be additional costs incurred for BCP or business continuity planning. There would be pressure from the associated enterprise, FCO in this case, to reduce the markup on account of the pressures that they would be facing. The comparability issues as to how do you go about quantifying, if at all you have to do a reduction of markup, what is the basis on which you do reduction of the markup? Should it be 1%? Should it be 2%? Should it, how much? How do you do that? Then there would be cash flow issues where, because if FCO is having a problem in collections, there would be cash flow issues, delayed payments, which also will create a transfer pricing issue independently. So how does ICO go about dealing with all these issues? So first, it's important to go back to the basic principles and examine the issue around characterization. So when we talk about characterization, the question to be asked is what exactly has changed? Historically, this entity has been positioned as a low risk entity. It is being remunerated on a cost plus basis. So what has changed? What is the new risk? What new risk is it assuming as a result of the pandemic? What has changed as a result of the pandemic? And is it possible to change the markup without any changes to the risk profile? Now, the counter to that is that low risk does not necessarily mean no risk. If there is no business, if the associated enterprise, if that associated enterprise's business is down, if it has no business, take the example of a cruise line. If the cruise line is not operating any cruises, there is no business activity. What are they going to outsource? And this is the view the overseas tax authority is going to take. So again, a classic case where two tax authorities are going to take radically different approaches. Now, coming to changes in markup, again, there are a lot of, so first of all, it is, as we've discussed earlier, one should not go about it as some kind of a COVID adjustment. One has to see the justification and rationale for any kind of change in markup in these kinds of situations. But yes, there will definitely be a case for making some kind of an adjustment. Now, getting the data for making this kind of adjustment is going to be challenging because the data available when the prices are set for the year, for these COVID years, you will still not have data in the public domain, which would enable you to decide how much margin reduction should be given effect to. So there are some approaches that have been used, like some kind of regression analysis which matches the profitability as against the GDP of countries for different years, and basis this some models are developed. But again, these are not tested. So one would have to be careful in how these things are implemented. So I think as a practical way to do it would really be to rely on the 35th to 65th percentile and try and see if you want to go to a lower point within the range. That to my mind will be more practical. Of course, there are ways to, as I said, regression and other statistical analysis. You can look at past international data, 2008 US data to see what kind of V-shaped recovery they had, and in the years that were affected by the economic downturn, what kind of margin reductions happened in that year for whichever industry, and try and draw analogy from that to see what kind of margin reduction can be given effect to. Then, as I said earlier, it is also possible to look at the certain domain specific impacts. And as I mentioned, I have a slide here which I will just bring up. So here, if you see, this is looking at data. This is a chart that you see. This is a comparative of how revenues and costs have moved on a quarter-on-quarter basis, pre-pandemic and post-pandemic. So this is the Q1 2020 compared with Q1 of 2019. So it's a little dated, but I just put it up as an illustration, as to show that within ITES, how have different verticals within ITES moved. So it may be, the need may now be to not look at ITES as a bucket, but maybe to look at a further segmentation and see which particular vertical within ITES that you are operating in, and make adjustments accordingly. Moving on to some of the other issues, and these are relating more to the costs. In case of idle capacity, the question is, it would be harder to justify this where the remuneration model is a cost plus simpliciter. But in case where the model is based on a cost plus, which is on the basis of budgeted costs, or possibly on an hourly basis, that would be, then there would be a better case for the Indian entity to undertake any idle capacity risk. With regard to the exceptional cost, it's important that one has to be able to identify that these are indeed exceptional, and really the test is, how does it compare with the third-party data. In case of certain costs, again, there could be a, do you totally exclude the costs? And since we are specifically talking about a captive, in a captive, the understanding is that all costs incurred by the captive are for the services that it is providing to its principal. And therefore, it is always going to be challenged with that you incur a certain cost and you don't recover anything. So possibly the better option is to do a cost to cost recovery. Maybe you do away with the markup, but rather than completely disregarding the cost, the better approach is to at least recover it on a cost to cost basis. The another important aspect is not only to look at the additional costs, but also what are the potential cost savings, because during this period, companies, while they have incurred additional costs, they have also saved a significant amount of cost. And in whatever analysis is being done or discussed with the overseas entity for reduction of margins, it cannot be done without taking into account what has been the cost saving, and to what extent is that cost saving being retained by India, or is that being passed on. And finally, there is the possibility to make adjustments to the third-party data. So again, one of the ways to do it is to look at the potential of making some kind of a capacity utilization adjustment to adjust the third-party data in line with what the taxpayer is, what conditions the taxpayer is facing. Now, in our next case study, we will look at a case study dealing with intra-group funding. Now, one of the negative impacts of the pandemic is the stress that is being faced by balance sheets, and companies are genuinely in need of funds, and which means that shareholder loans and guarantees, they are likely to see an increase, and that's where something like this becomes relevant. Now, coming to financial services, financial transactions, a key differentiator in the transfer pricing of financial transactions is that these are always transaction specific. So you will find a much greater prevalence of a method like the cup method, and a very little or almost no use of the profit based methods, because the transfer pricing here is not at all concerned with the business result. It is more concerned with the pricing of a particular transaction. Now here the brief facts of the case are as follows. There is a parent company, FCO, a foreign company. It has given a guarantee to a third party lender, and please assume this to be a foreign bank. And this results in an increase in the borrowing capacity of ICO, which is a 100% subsidiary of FCO. And it has increased the borrowing capacity from USD 50 million to 70 million. And another benefit is that it enhances the subsidiary's credit rating. Now, while dealing with intra-group financial transactions, the first question that we typically get asked is, what should be the interest rate or what should be the coupon? And it's very important in analyzing these transactions to not restrict our view solely to the coupon rate, because there are a number of other issues that need to be considered. And the first one is, will the loan be respected as a loan? And that's extremely important. That is the entity, in this case ICO, is ICO sufficiently capitalized such that it would be in a position to borrow on its own? If not, whether the loan itself will be respected as a loan is a question that needs to be considered. And this is something that comes out of the OECD guidance as well, which talks about the accurate delineation of transactions in undertaking any kind of a benchmarking. The second is, when you talk about the guarantee fee, should ICO be paying guarantee fee on the entire amount of 70 million which is being guaranteed, or should it be paying only on the benefit which it has received? And the benefit is the enhancement in the credit rating and the increase in borrowing capacity. So there is an argument to say that the ICO should be paying a guarantee fee or some compensation only to the extent that it has received any benefit as a result of it. Then, apart from transfer pricing, one also has to take into account and the implication under section 94B, which limits the amount of interest deductible on related party loans or loans which are guaranteed by the related party to 30% of EBITDA. So this is an independent consideration that needs to be borne in mind. And finally, needless to add, given the arrangement that we just that was on the chart, the possibility that this could be treated as a deemed international transaction, that is something that also needs to be considered. Now, having gone through the principles and the 3 case studies, now we have come to a point where we can summarize the key action points that would require our attention in carrying out an analysis during these periods. So the first, so again, these are all items which we have discussed in the past slides, and this is just a quick summary for our reference. The first is documenting the economic story, maintain an adequate amount of evidence of how the pandemic has impacted not only the taxpayer itself and the industry. So what has been the impact? What is the impact of the pandemic and what is the economic story? That is absolutely the first step in making any kind of a claim. Then identification of any extraordinary costs that in anything that is being borne by the taxpayer, which is on account of the pandemic, which is extraordinary, this needs to be identified and again, properly evidenced. Then there is another approach which we have, if you see at the bottom, it is a but for COVID analysis. So basically, this is to say that but for COVID, this would have been the outcome of the year. So essentially, you are trying to say that whatever has happened as a result of COVID. So the but for COVID analysis means that but for COVID, this would have been my result, and therefore anything that has happened is not on account of inappropriate transfer pricing, but it is on account of COVID. So again, this is something that, these are all, corroborative supporting analysis, which would be useful when it comes to defending a case. Then coming to benchmarking approaches, it's here in these kind of matters, it's good to try and see if more than one transfer pricing approach can be used. Wherever there have been actual negotiations with third-party vendors and external any other third parties, customers, vendors, they can be used as an evidence and proxy of how a negotiation would take place between third parties. Any adjustments should be properly supported and documented. And again, as I said, we could consider using not the full year, but use quarter-wise data to try and see if any adjustments can be made in that manner. Finally, consider renegotiating or modifying or terminating any intercompany contracts. And also there is there's an important implication in case you have already entered into any advanced pricing agreement. Because typically an advanced pricing agreement under the law, it is for a period of 5 years, and it is binding on the taxpayer. If you have agreed a particular price in the advanced pricing agreement, then that price has to be followed for the entire duration of that agreement. Now, if there is a significant impact on account of COVID and it just makes it unviable to proceed with that kind of an advanced pricing agreement, then the sooner you approach the tax authority, the better. There is a mechanism which is provided under the APA rules to ask for a revision to the APA, and based on whatever conversations that we have had, the relevant authorities are pretty open to look at genuine cases and consider any kind of changes or modifications to APAs that have already been signed. And any APAs that are in progress, anything that is still being negotiated, it's important to include some carve out, something for the COVID affected period, so that an appropriate adjustment can get reflected within the APA itself. And finally, whatever positions are taken in during these pandemic affected years, very important that the one looks at what is the potential that this could have, how could it potentially affect any of the past years, as well as how it would potentially affect the future. Now, going beyond the pandemic, and I think in the opening, Rakesh ji was talking about some of these aspects. What we have really seen is that the pandemic has brought about some real transformational changes in business models and delivery models. Virtual interactions have become a necessity, and increasingly they're very, very likely that these are going to remain, and it will be the norm really going forward. So in this context, there are a few issues that I just wanted to touch upon here, which would be very important as we look at the years going beyond the pandemic. The foremost is the role of technology. Now, for a long time, technology has been viewed as more of a support activity for most businesses. However, the past year and a half has shown all of us that technology is most pivotal to running almost all businesses, and now I think it's more of a given. That is going to be the norm. So therefore, any assumptions that have been taken in the past around whether technology is a back office function or a support function, or is it really in the nature of a core activity? These assumptions will have to be revisited. And as you will appreciate, the TP model itself can undergo a change depending on whether you view an activity as a core activity or a support activity. So in the past, you had any kind of technology activity in India, you could very well say that, yes, the discussion is limited to what should be the cost plus markup because it is a support function. But going ahead, if technology is going to be considered as a core function, in that case, do you really continue to justify a cost plus kind of a remuneration, or does it really need to be looked at differently? One leading example I can think of is the area of fintech, which has seen not only exponential growth, but there is a direct convergence between financial services and technology. So again, in a fintech situation, while the company may be even regulated, undertaking financial services, but technology will be really at the core of any fintech business. So very difficult to say that technology is a support. It is very much a core. And this is a trend that we are increasingly seeing a lot in banking and financial services. Another area is the whole aspect of cyber security, which has become so vitally important when dealing with financial transactions as well as personal data. Again, a great example of whether you would really consider this as something which is core, or will you consider something this is as support. We also see a trend where a lot of cases where technology which has been viewed as a support by organizations, they are themselves coming to a level of maturity where whatever technology that they have developed for internal purposes, they are thinking of licensing it out. So again, a case where a support function is transforming into something which can be a revenue generating function. So again, the message here is that given India's preeminent position in this whole technology space, this is an area that merits consideration and needs to be looked at very carefully going forward. Then moving on, with remote working increasingly becoming the norm, we are seeing increasing instances of persons who are physically located in jurisdictions which are outside of the entity that they are employed with. Now, this problem has both been temporary. So during the pandemic period, because of travel restrictions, people have been forced into these kinds of work arrangements. But we are also seeing, and based on my own interactions with clients, we are seeing a lot of these things being more permanent, where people now want to live in a different place. So now that remote working has gone way beyond a proof of concept, people actually want to work in different jurisdictions. So you could very well have a situation of a person sitting in India undertaking some global role. You could have a person sitting in India which historically carrying out activities which typically you would not have associated with what they would have in the past done in India. So this requires an examination from the perspective of, is there any PE exposure for the non-resident entity in India as a result of these activities? And again, it can be converse as well. Equally, you'll have India employees sitting overseas, so equally it will apply the other way also. Could there be potentially any POEM exposures for the non-resident entities? And also the transfer pricing model itself in these kinds of situations needs to be reevaluated. Another change that we are seeing is in relation to reporting structures, where as a result of these kind of changes, you will have teams are working in more of what we call a desk extension model. So there is a less amount of demarcation between between an overseas team and an offshore team, and they essentially are working as one extended team. There are a lot of cross reportings that happen where India employees are actually performance managers for overseas employees. So these are areas which are now emerging and which will make the transfer pricing structures more and more complex. Then another area is as a result of the pandemic and related changes, there are functions which are getting restructured, and this has to be examined from the point of view of an exit charge. So exit charge is really a one-time compensation for a business restructuring. So in a very loose term, this is a compensation to a jurisdiction where a valuable function is transferred outside that jurisdiction. So today, if you, let's say, have a cost plus contract which is getting renegotiated, then potentially you need to examine, is there a likelihood of a liability for an exit charge? So again, a relevant consideration in the next couple of years. Finally, I would just like to talk about some of the changes that we are going to see in terms of the tax scrutiny by the revenue. So as we are all aware, notwithstanding the glitches that we are seeing in the portal, but the revenue has certainly invested a lot in terms of effort in collation of data from various sources and invested and emphasized a lot on their data analytics. So whether be it data coming from 26AS or CBCR data or exchange of information or data coming from the indirect tax side of revenue, I think a lot of future assessments are going to be more data driven. And really, this is going to be a challenge for taxpayers to keep pace with revenue, because revenue is definitely has a lot of data in their hands, and taxpayers need to be prepared for that. Faceless, while currently we know that transfer pricing is certainly not under faceless, and there is some news about larger taxpayers also going out of faceless, but sooner or later faceless is going to come. So again, an area that needs to be planned for. Finally, given the nature of the disputes and the potential for economic double taxation, the appropriate use of mutual agreement procedures involving treaty countries, as well as bilateral APAs, these are two mechanisms available which can completely alleviate any potential of a double taxation, economic double taxation, which otherwise is an exposure in transfer pricing cases. So that brings me to the end of the presentation that I had prepared. I think we're about 11:15. That's what I targeted, to leave some time for any question answers that we may have. So I will stop sharing my screen at this point, and thank you to everyone for a patient hearing.
Thank you, Waman, for this elaborate explanations, and especially the case studies which are very relevant from the distributor model or the IT enabled or even financial transactions. Couple of questions that have come up here are, the first one is saying that, profit split method, now that is being tested separately by companies which are having losses versus companies having super profits. Now, how do you balance it? Because tax officers may apply PSM for life science versus taxpayers may be interested in, say, other industries. So how do you look at profit split method?
So again, in my practical experience, I have not seen too many cases. So the typical industries where I have seen profit split is telecommunications and in certain financial services transactions where I have seen profit split. Clearly, I can understand that in life sciences, especially if you are, if there is a position where there are intangibles being developed in more than one location, there could be a case now for profit splits. We are increasingly seeing this as a possibility in some of the technology related areas. The fintech that I mentioned is another area where we are seeing possibility of profit splits. Okay, I think the message is that yes, this is an area which is not really tested too much. There isn't much of jurisprudence that we can point towards, and I don't think it's an area which is very fact specific. So my advice in this is that I would go with the first principles. That first of all, is a profit split method applicable on first principles? I think that's the question number one. Is it something that is being implemented only because I have a loss and it's inconvenient and that's why I'm using a profit split? Because it has to be consistently applied. Second thing is that the data, is there an ability to share the complete data with the tax authorities? Because that is another challenge, because if you are doing a profit split within whatever number of countries, do you have the ability to share the data with the Indian tax authority of all the countries? That's, I would say, it's pivotal. And finally, is it something that is going to be consistently used? So I think in principle, if the profit split method, if the necessary conditions are satisfied and it is permissible, I think there is no objection. I mean, I would certainly say that it is something that can be used, but one has to be prepared for a challenge because it is not well understood, and the likely view from a tax authority is going to be that, okay, are you using it because of some reason that you do not have a profit or you do not want to use TNMM? That's going to be the initial reaction. But other than that, there is no reason why a profit split cannot be used.
Okay, thank you. Then there is a question from Mr. Sagar Joshi, who says how to deal with a situation where section 115A provides exemption for filing return and the income transaction is with group entity, whether form 3CEB is to be filed, where return is not to be filed.
So this is a very subjective call. The advice that generally again, it really depends on taxpayer to taxpayer. There's clearly a case to argue that it is not required. But I know that there are a lot of taxpayers who do not want to take a risk, especially given the potential penalty exposure, which I mentioned, of 2%. So I think, I'm sure Rakeshji, you would also have,
Yeah.
But I think this is really there is no one answer for this. It entirely depends on. I think the technical answer, I would say that it is if there is no requirement to file a return, ideally there should be no requirement to file a Form 3CB. Having said, this is not the practical answer. Practically, I know that there are a lot of companies who would prefer to do the compliance to avoid any potential for the 2% penalty.
Right. In fact, I had a chance to discuss with one of the commissioners on this aspect, and his theory was that what is Form 3CB? Form 3CB is only a disclosure norm wherein the officer knows what you are doing. He's not asking you to pay any taxes, or he's not asking you whether it's really an adjustment that you are making. So what is the harm in disclosing? On top of it, what is said is that today, if you see, you have been given exemption for filing return, but there is no specific exemption that is given for 3CEB. And as a result, if you don't file 3CB, he has the power to levy penalty of 1 lakh rupees plus 2% of value. Now it's up to you whether you want to disclose or you don't want. On top of it, he said that the officer, unless he knows that there is a transaction, how will he take action? If you don't disclose, how will he ever know? It will go out of the system. And therefore, his recommendation is, we are just asking you to disclose. So please disclose. Otherwise, I can't stop my officer from charging the penalty. So the call is now, as Waman mentioned, on the officers and taxpayers. Better to be, prevention.
What we can confirm is that it is possible to file a Form 3CB without a tax return. That I can confirm. That is possible.
Right. Absolutely. Yes. Then there is a question from Aparna Naik. She has said that with reference to your case number 1, wherein the third option discussed was to convert LRD to an entrepreneur. Okay, so you're making a business So would such a change in FAR be construed to be a business reorganization? And in such a scenario, would an increased markup on a recurring basis be sufficient both from the parent perspective and company's perspective? So she is referring to your case one, third option.
Sure.
Related to entrepreneur.
I think that's a very important point. And the way what we are talking about here is that when we say entrepreneur, you are saying that the limited risk distributor is now being converted to an entrepreneur. And when we say entrepreneur, what we mean here is that it is a full-fledged distributor.
Right.
So all the risks and rewards of the distributor. So it is then we are moving to a point where the distributor, you're not going to target a fixed margin. So potentially, if there are local marketing intangibles that are developed, those marketing intangibles will also belong to the distributor. The distributor has a greater say over what kind of activities are going to be done in the market, what kind of advertisements, what kind of promotions. All these kinds of decisions will then be taken locally. So which means that there could be a possibility of a loss, there could be a possibility of a super profit, both ways. Secondly, also as I mentioned, the credit decisions. So if you have a situation where you say that I'm a full-fledged distributor, am I taking the credit decisions? Am I going to be taking the bad debt risk? And it is not enough to contractually assign it to the distributor. Does the distributor have an adequate size of balance sheet also to be able to absorb such losses? So all these factors considered, if the conclusion is that yes, all these activities are happening, then clearly, yes, it can be characterized as an entrepreneur. Now, if I'm the tax officer, I will say, okay, why is it that you remembered all these things in the year of COVID when you could not get the targeted margin? Right. So my assumption is that you were doing all this for the last several years. So then I will go and reopen all those years. So then can you show based on fact pattern that yes, because of COVID, I had to approach this market differently. I had to delegate a lot of these local decisions to the local team. I actually hired local people. So is there something that I can show that activities are different? So number of employees, how many people are employed, what are their contractual terms, what are their incentive structures? So has anything changed substantially from the preceding year to this year? This kind of fact pattern will be crucial.
Right. Thank you. The next question is, how do you see the bright line test evolving for India? Is there any update on the same?
I think we are all eagerly awaiting the Honorable Supreme Court to deal with this issue. I believe next week is when the case is scheduled to be heard. Again, the bright line is something which is, I don't think conceptually there is any problem in the bright line. It is just that if you start using it mechanically, that is where the problem arises. Otherwise, what is the bright line? The bright line is essentially you're saying that, are you undertaking some very significant activities which is beyond what you would normally do as a distributor or whatever your role is. I think the objection the only issue is that if it is applied mechanically, then you have a problem. But otherwise, conceptually, I don't see that there is a problem in the bright line. But of course, this is my personal view. We will have to wait for, I think it's a matter of few days now. The Honorable Supreme Court is going to hopefully rule on this matter.
Right. And just to add to what Waman said is that yesterday we did look at the pillar 1 and pillar 2, where this distribution and marketing intangibles were dealt with. So probably the Supreme Court might take cognizance of the material that is now available with OECD on this front to deal with what should be the attribution that should come, if at all, to be done. So one needs to link with yesterday's session with this question as well. The next question, Waman, is you mentioned about the quarterly data and use of more than one method. Now, if you do it for this year, whether it will set a precedent for the income tax office to every year call for it, because the reasoning that you may give is to make it more comparable rather than a pandemic.
As I said, the two are, I don't see the two as unconnected. The improvement in comparability, as I said, is only because of the pandemic. So the example that I gave, you see, April to June quarter this year, when we had a raging second wave and a lot of localized lockdowns. So certainly I can say that economic activity in the first 3 months was very different. And hopefully now, let's say, hopefully we don't have a third wave, and let's say the rest of the year is a business as usual. I can definitely make out a case that for the first 3 months, the economic activity was different. It was different to the rest of the 9 months. And therefore, I am making out a case for this 1 year. Now, whether it will be challenged, most certainly it will be challenged. Whether this is going to set a precedent for what I need to do in the next year, perhaps not, but I will need to, in whatever documentation I maintain, I will need to explain the reasons why this was a 1 year, this was just a 1 year one-off thing that I had to do because of the peculiar economic circumstances, and it's not something that I'm obligated to do year-on-year basis. And also, there is no obligation. The law requires me to do it on an annual basis. There is no obligation under the law which can compel me to do this.
Right. And just to supplement what Waman mentioned, you can also refer to the administrative cost involved in getting that data on a year-on-year basis. That may be of help. The next question is essentially force majeure clause, whether can be invoked between related parties, especially like industries you mentioned about the cruise line and airlines, for not giving any markup at all.
But I think here the important point is how, because the basic principle of transfer pricing is that how would third parties behave in a similar situation. So if there is a credible evidence that force majeure has been exercised in a third party situation, it is something that one should be in a position to defend. But again, the test is there evidence of a third party doing the same thing?
Fine. Then the next question is from Sunil Nayak. He has said, due to COVID scenario, if foreign entity decides not to charge interest on loan given to Indian subsidiary, in past interest on loan given to, in the past interest was charged, will this lead to any TP consequences in the hands of foreign entity given that interest income was taxable under the Act and DTA? So he's saying about the foreign entity filing the return of income.
I think this is a risk, and so certainly as far as Indian entity is concerned, you have subsection 3 of section 92 which would apply. But in the case of foreign entity, and we have the Instrumentarium Corporation decision wherein the argument of base erosion was not looked at favorably by the court. Having said that, one would have a number of arguments to place in this kind of situation, that what were the economic circumstances under which this was done, and the non-resident, in this case, is the non-resident acting in its capacity as a shareholder and therefore giving a waiver of this interest. One also needs to consider what would be the implications of this going forward. Will this then bring into question whether the loan is in reality a loan or not? That's a larger question that we will have to deal with. But given this year, while yes, I can certainly see that it could be challenged, I think there will be a reasonable defense to say that given the economic circumstances, this was done as a shareholder.
Right. Waman, while the questions are coming in, I would request everyone to put the questions. We'll pass it on to Mr. Waman, and he will, forward a respond to it. But last question, let me ask, is, the government has been selling its or marketing itself as ease of doing business in India. How do you see that drilling down to the litigations in India, especially on transfer pricing?
So the last year and a half, when a lot of the courts have been working in a virtual manner, I would have thought it would be next to impossible for tribunals working on a virtual format for fact-based matters like transfer pricing to get heard. And I am very happy to share that there are a number of cases which I have personally been involved in, where reasonably complex matters involving, multiples of comparables, which would be very difficult. And, large paper books, I mean, sometimes, 1,000-page paper books and large number of companies, this has actually happened. So, I mean, that's something which I see as a very positive step. Is there a room for improvement? Yes, I think there is certainly room for improvement. And when we talk about ease of doing business, I'm sure that it's always there's always something that we can do better. But I take a great deal of satisfaction from what I've seen in the operation of the tribunal, and my personal experience. I think a lot of cases we've been able to do during this period.
Right. Thank you for candidly sharing all your thoughts. May I request Abhishek to give a hearty vote of thanks. Abhishek. Abhishek, you are on mute.
Is it audible? Thank you.
Yeah.
It was a great pleasure, and it's a heartfelt gratitude from WIRC of ICI, sir, Waman sir, to listen to you. And on a Sunday morning, it was a great pleasure to hear about the TP and its provisions, and the pre-COVID and post-COVID, the transfer pricing regulations, which are going to change the appropriate method of calculating the arm's length price, and the practical case studies which you talked about, and certainly about the technological change and the data analytics, which would have a larger impact and the say in coming days of transfer pricing. Certainly, it was a great pleasure in listening to you, and certainly very thank you to Rakesh sir, who has moderated the complete session in a very successful manner and taking the question answer round. And I also thank all of the members of WISC in participating in such a large numbers and being such a wonderful participants with respect to the session. Thank you very much, sir. And I would request Aditya, who is the coordinator of the next session, to take over the session.
Right. Thank you, Abhishek. Just before and thank you so much, Waman sir. Before we start with the next session, there is a request that we should have a 5 minutes nature break. So let's wait for 5 minutes and then rejoin after 5 minutes. Thank you. So welcome back, friends. So we are now starting the next session after a detailed, interactive session with that of Waman Kale, where he shared about the transfer pricing. Aditya is the coordinator. I would request him to definitely give at the end on the vote of thanks. Let me first introduce all our three eminent speakers today. We are really lucky because each one of them has more than 20 years of experience in international tax. Welcome Sanjay sir, Ketan sir, and Manisha ma'am for our WRC sessions.
Thank you, Rakesh.
It's a pleasure to have you all. As a formal introduction, I won't get into more time from the sessions, but starting with Manisha ma'am, she has more than, as I said, 20 years plus experiences. She is a global transfer pricing leader for Baker Hughes, which is the US $20 billion oil and gas company. So you can imagine global TP leader is with us. That's a pride for WIRC. Prior to this, she has also worked with BH and even GE, wherein she was leading the GE's global center of excellence. So we have a person which has a global outlook. And on top of it, in her free time, she also enjoys trips and to mountains and even practices yoga. So you can just think of this eminent personality who is going to share the thoughts with us. Thank you, Manisha ma'am, for attending this session.
Thank you.
Our next speaker is Sanjay sir, who is ex-commissioner of income tax directly, and now is also an advisor to Deloitte. He is essentially, also a professor right now at Dell University in USA. So again, we have a global person here. On top of it, he's coming from the department and also is looking at the consulting and also has a global perspective. So yet again, a very, very eminent personality. Welcome, Sanjay sir, to our session.
Yes, thanks, Rakesh.
And third, we have Ketan Ved, who will be the chief moderator for this session, who will be asking all the or shooting all the questions. Ketan again is 20 plus years. He's working very closely with all the legal counsels, the topmost legal counsels, you name it, Ketan is with them. And also a partner at Deloitte, has an excellent experience in actually working with all the tribunals and courts. So 90% of his time, you can see him in the courts. So what a better person can be to look at this controversial things that are happening in India. So with that, may I request Ketan to kickstart this session and let's have a debating, question answer sessions also. To the participants, I would request them to please put it in the chat box. We will take it at the end of the session, just like what we did for the transfer pricing session. So all over to you, Ketan.
Good morning, everybody, and very good morning to my co-panelist and Rakesh. So quickly before we get on to the panel discussion, I just thought it is better to refresh, just in a couple of minutes, what happens in the traditional flow of tax litigation in India. The assessee files the tax return along with transfer pricing return, etc., transfer pricing report, etc. Then the assessing officer selects a case for a scrutiny assessment, refers it to a transfer pricing officer. Depending on the transfer pricing officer and the assessment order passed, the assessee can choose to go down the CIT appeal or the DRP route. Both the routes have its own advantages and disadvantages. Then from there, we move on to the Income Tax Appellate Tribunal, being the final fact-finding authority under the Indian tax legislation. Questions of law then travel to the High Court and then to the Supreme Court. While this is the traditional route of tax litigation in India, we are all conscious of the fact that going down this route takes a sizable amount of time. And with that background, the MNCs want certainty in tax matters, because what is more important is business and continuation of business, and hence with this background, the traditional route of tax litigation is seen as a kind of a roadblock, and hence people look at alternate ways of resolving disputes, or maybe resolving disputes before it can become disputes. So what are the alternative dispute resolution modes which are available? The board for advance ruling, or the erstwhile authority for advance ruling, the erstwhile income tax settlement commission. We have also in the recent past seen writ petitions filed before the High Court if it is permissible under Article 226 of the Constitution of India, mutual agreement procedures, and the advance pricing agreements. So with this background about the tax litigation, I would now start putting questions to my esteemed panelists. The first question is to you, Sanjay sir. What has been your experience in getting cases resolved in MAP? And when I mean experience, what kind of disputes get resolved in MAP, and how long does it take?
Thanks, Ketan. I hope I'm audible clear enough.
Yes, sir, loud and clear.
Yeah. Okay. So thanks a lot for having me here. I have been in the many ICI sessions, and also contributed to these training programs in Delhi. But I suppose this is probably the first time I'm on the WIRC panel. So
welcome, sir.
Happy to be here, Ketan. Ketan, when you talked about the MAP, MAP is a pretty generic. There are two parts to the MAP. One is the bilateral APA resolution that also goes as a mutual agreement procedure. But the question that you asked, it gives me an idea that you are talking about the MAP resolution after the disputes, and after the disputes have come, because you talked about the MAP being resolved, cases being resolved in the MAP. So I would take it that it is the audits have happened and then the disputes have. I mean, I must say that India has worked on that MAP quite well. And in the last a few years, if I can take a telescopic example, then almost like 800 cases have been resolved in MAP in the last few years. Large number of cases, of course, around 200 or so, were the IT-ITS cases with the US, and on that there was a framework agreement, and the government of India as well as the US IRS got onto a framework by which a large number of IT-ITS disputes could be resolved. So they developed a formulaic approach to the MAP resolution. Apart from that, they have also resolved about 125 MAP cases outside this framework agreement. So both the things have happened. So close to about 325 or 350 cases have been resolved with US alone. Apart from that, there have been resolutions with UK, Japan, Sweden, France, Australia, Germany, and Singapore. And I must say that India has a large treaty network, almost like with 100 countries. And those are the countries which contribute to the trade flows and to investment flows. So overall, what I feel is the MAP is a good way to proceed and resolve if there is an issue of double taxation, because that is a central point if anybody can invoke MAP. And another, when I talked about the cases, the large number of cases which have gone resolved, which are away from the IT-ITS, they could mean the intragroup services, royalty payments, manufacturing, some of the cases, and then non-binding investment advisory cases also. So there is a whole clutch of cases and there's a large menu of cases which have been resolved by India through the MAP procedure.
Sir, an attached question, while what you refer to of cases being resolved under MAP are cases from a transfer pricing point of view. Do we have many of cases from an international tax point of view? Maybe classification of items or existence of PE, etc.?
Okay, since you took the example of PE, on the PE, there was a little bit of uncertainty earlier. But then when the BEPS Action 14 came and the OECD started doing the peer review, I understand that that in one of the reports that has been published very recently, India got to admit in a very not a very direct manner, but said that it has never denied a MAP access on the PE issues. So, and has never refused any cases if the treaty partners have accepted the MAP, the permanent establishment issue. So they are also, I suppose, get resolved. There was a little bit of difficulty earlier, but now I suppose that cobweb has also been resolved. So I would say that P issues have also getting to be resolved through the MAP.
So another question which I would want to pick your experiences, sir, has there been an impact of the current situation where, say, because of the COVID-19 pandemic, the competent authorities are not able to travel? How has that impacted MAP resolution? Are maps on a standstill or things are moving?
I would not say that they are on standstill, Ketan, because pandemic did affect on both sides, most of the countries. There was a kind of lockdown situations. The offices were closed, and similar situations were there in the CBDT, in the Indian MAP team also. But if we leave some of these times away, the most of the meetings have started coming on through the Zoom or some such platform, web platform interaction, and they exchange their position papers and try and resolve as much as they can on those cases. So it's not really important that they actually come in physically. And if the world has changed its way of interaction, so the tax departments have also changed, and they are largely doing it through online system. And I think the large number of cases have got resolved through the MAP also, though interspersed with some difficulty if the officer is not well, or on the other side, the countries are experiencing some pandemic situation. So those have been the little bit of gaps, but notwithstanding that, the rest is fine.
Moving on, Manisha, good morning. The first question to you is, what would be a primary or a major consideration for a taxpayer or an MNC to decide whether it wants to go under the normal dispute resolution mode or going for settling the dispute under the MAP?
So hi, thank you, Ketan. And firstly, Ketan, your voice is breaking.
Oh.
So yeah, and while I can hear your question, I'm not sure whether it's audible to everybody. So I think that's a real, it's a real question on, it's a real decision, I would say, on when you're making a determination on whether to pursue a litigation through the normal channels and eventually landing up in the courts, or considering that you would do an MAP. In either of the situation, we are talking about the transaction has already happened and you are under litigation already. So you're really deciding what route to take. I would say a lot of factors. To some extent, Sanjay sir talked about, the issues pile up, like IT-enabled services issues may pile up. So I think the first thing to see is critically, what is your issue? If it is something that is en masse across the industry, then you may want to just follow the pattern because they'll get settled together, perhaps, rather than go independently through the court and try to get an alternate view on it. So the other, of course, assuming that it is not a matter which is, if it's not a matter that is among the common issues that are piling up, like IT enabled or just waiting, the experience with the court matters. And we see this globally, Ketan, around the world, to say, what is the experience of the courts on this matter? And it differs country by country. It differs almost every 5 years, on what is the current view of the court on the matter. Now, why do I say that? Because transfer pricing matters typically tend to be very fact intensive and a little bit low on the law as such. The law is, you need to be reasonable, you need to be logical, it needs to be economically correct, and of course within the parameters of the timelines and the way the legal framework has been made. But a lot of it is so nuanced around facts that taking it to the courts, and are the courts inclined to go through that entire fact finding exercise or going with you, rather than what they are used to, which is the interpretation of the law. So you want to see the experience of the courts the way it is going, right? And then the timelines involved. Often you find the court procedure may take too long. And that has certainly been the experience in India, right? You may find that, look, if I go down the court route outside of, and I'm assuming appeals and ITAT, and your matter is so big that you will land up in the court, that it may take a very long time. And from a business perspective, that means an uncertain tax position for a really long time, which itself can be quite harmful to the business to carry those. And I wouldn't get into, but as a US company, from an accounting standpoint, you would have to make a FIN 48 provision for an uncertain tax position, review it quarter by quarter. And, so how long do you carry that? And, so that timeline and when you will get justice matters. And then there are rolling effect of the matter as well, Ketan, right? Now, if you go into the MAP or if you go to the court, that every year the same issue may come up. For a large industrial company such as ours, the transaction tend to remain the same every year, and if that matter is litigated, then you've got a year-on-year issue. So do you want to go to the court, for that matter? I mean, you have to see whether maybe the MAP is better in that case, to take the matter and then resolve it for once. And lastly, I would make a more generic point is I did say that the courts may have other consideration. What is the way the MNCs are being looked at, at a more topical standpoint during those years? Are there other human rights issues around your, transfer pricing is a subject, somehow interests a lot of groups. So you sit around and you look at your transaction, the complexity of the matter, the issue at hand, the timelines involved, and then take a route to say, do I want to pursue this through court or do I want to go through this MAP? And I would say many a cases you will point towards the MAP. And involve, for a multinational, both sides to come together and, try and resolve it. As we know, it's not a mandatory that they have to reach a conclusion, but at least they will sit together and resolve it. So I would say these are the macro considerations, should be, because if the issue has already happened. And then I think during the course of this discussion, Ketan, we will talk whether we can take a step back and not even reach a point where the litigation has reached this point through an APA or other matters, right? Other tools. Hey, Ketan, you're on mute.
Yeah, Manisha, just to add 2 points to this from, as you correctly put, transfer pricing is a factual exercise. And factual exercise at the transfer pricing getting resolved is more or less seen at the tribunal level. And you would reach the income tax tribunal within a couple of years of the dispute happening. Obviously, while the tribunal decides on a particular matter, in the past, there was some fear that whether the tribunal members were also aware of the sophisticated transfer pricing methodologies, etc., etc. But as they have also now, transfer pricing disputes in India have started from around, it reached the tribunal somewhere around 2005. And today we are in 2021. So 15, 16 years of experience. Even the members of the tribunal have, got a very good grip on the transfer pricing matters. But as you rightly said, depends on various issues like continuation of disputes, stakes involved, etc. Because in the tribunal you would have to share upfront, now with this amendment 20% of the amount which is demanded. Moving on to the next question, Manisha, this once again is to you. Any specific instances in your experience of handling MAP cases which you think would be of interest to the larger audience?
I think the ones that where I found is particularly you find two parties that are really keen to come together. And I had a live experience was with the matter of intellectual property. Particularly if it's an interpretation of a cost share agreement, or the way you look at the income related to an intellectual property. I've seen both APAs and maybe even PE, but let's stick on the intellectual property, which tends to is a planning tool that you would use, and then for many years that structure will stay in place. I have seen that the MAP, if it's matters under litigation, is a useful tool. The reason is that we need to have a reasonable approach, and it's one of the hardest things to value, right? And cost share somehow tend to get quite a bit of controversy around it, the interpretation around one party wants to have. And I'm talking about even two European, US or a European. So these are even developed jurisdictions that have issues with cost share, and these, jurisdiction, Ketan, as you said, have fair amount of experience with transfer pricing, having their own interpretation on intellectual property. And that's where we said we will go into MAP, because we really want the two countries to sit together and look at an approach which is acceptable. So I think whenever we have a strong matter of intellectual property, because again, I come from a more industrial setup where IP is very important, we certainly look at the timing of the issue, whether it is after the fact or before the fact, but one would go into either an APA or an MAP and get your countries involved to be able to fight together with you, if you will, because that goes beyond just the taxpayer, but you can channel in also the taxing authorities. And Ketan, at this stage, let me add, the COVID-19 certainly has had an implication. If you think of not just whether they are meeting, and of course, how facilitation is happening, which everybody is adapting, I would also say that at the same time, the taxpayer system margin has shrunk. So from and two things have happened at the business end. One is what we used to see at the profit in the system has become much smaller. So what would be an acceptable position in a negotiating table, perhaps pre-COVID and during COVID, would be a different thing altogether. So we've had a few discussions where we want to say, should we, what should our position be? And again, in MAP, you are out of the picture, right? But in APA, you are in the picture as a taxpayer. The other point I wanted to make, one from an industry perspective, one is the taxpayer profit, and the other is the budgets for dispute resolution. When you go up to the CFO or to say, I want to do an APA upfront because I expect this to be a litigation matter, it's say that's really expensive for me to put right now. So the COVID-19 has changed the scenario of how disputes were being looked at, and at the same time, remember, tax audits are a major revenue collection tool. So it's not like it's going to go away, right? So it's all happening simultaneously. Tax audits are going to increase because there's a fiscal pressure on the taxing authority. At the same time, we are seeing a margin erosion, budgetary constraints that are coming on the taxpayer. So it's a very interesting time, I think, in the next few years, where audits will be coming up and there'll be pressure to resolve them.
Manisha, sorry to divert a bit from the subject of dispute resolution. I would just go a step before that and ask you, since you are in that flow, is there anything which a taxpayer should bear in mind, to prepare itself for handling disputes even before assessments are taken up? I mean, do you see some merit in the use of technology, risk assessment, and other things?
No, and that's a really good point, Ketan. I think in the previous session, I logged in just a few minutes before our session began. There was a conversation on technology investment and how data analytics is the new world. And as CAs or as tax professionals, we got to embrace it very, very quickly, and not stay in the comfort zone of the way things were previously. But what I would say is that for once in our experience, and I was in another conference where BVD was participating, Ketan, and BVD is a big supplier, as you know, of comparable data to transfer pricing. They mentioned, their representative mentioned that their largest projects today are not with corporates. It's actually with the governments. And governments around the world are investing in transfer pricing headcount, having transfer pricing knowledge, to your point, how the ITAT has picked it up as well, and also technology investment, right? And at the same time, we are also seeing that CBCR data is flowing into it. Massive amount of data is flowing. CBCR data, master file data. There's e-filings that have already started in Europe. So what we are really saying is that unless you have a technology plan, even within the company, that you're probably for the first time going to be behind the tax authorities than ahead of it. You know, as a taxpayer, we felt, you know, the government was catching up with technology, but that's sort of reversing. The governments are heavily investing into technology. So what is the technology plan is an important one to look at. And I think for a topic for another session, perhaps, Ketan, is to talk about tax transformation itself, you know, what that journey will be for every individual company. But certainly if you're not thinking about the tax transformation, then you need to catch up really quick. Taking a specific cue from your question, I would say transfer pricing documentation continues to be the basic building block. And while we may think of it as a compliance item, it's actually an item that you can also prepare for dispute resolution. How? Right? So if you think of, whether you have a centralized documentation, decentralized, hybrid, whatever model that you kind of thought of, and again, that connects to the transformation, mega view that you have on TP in your company. But either way, an ability to identify the risk areas upfront. Which are those risk areas? You know, which are the entities that have losses? Which are the entities that have had a significant drop in profit? So if you can identify those, where were the business restructurings that had happened? And do you have a new royalty structure or something that because of a change in a planning structure? I would say some of them and more may be an indication of high risk. And when they are being documented, that itself can be a step towards avoiding or responding to a dispute that is coming at a later stage. Now, having a control of that and documenting it at the correct stage, you know, is an important one. Then preparing for disputes around the timelines. Many times, you know, do you have 30 days to present your TPD? Do you have 45 days to present? Do you have to translate it? So, you know, if you have a macro plan of, say, when I'll be audited, the first thing the tax authority will ask is, give me your transfer pricing documentation. And are you able to give it at that stage, or do you begin at a much more footnote? You know, it's going to take me 2 months to pull it together or whatever. It's not a great place to start. The last point I would say about this, Ketan, is that remember the audit cycle is 3 or 4 years after the transactions happen, right? And people in the company will move on to new roles. So unless the transfer pricing documentation has captured the facts as you needed it, the backup documentation as you needed it, it's going to be quite hard to do that at that stage. So a plan to both archive your TPD and its related material, and to look at these critical risk triggering entities or transactions upfront and archive those, that would be critical too. So I would say take a step back and look at your TPD stage of the transfer pricing within the company, and start thinking about dispute resolution. That will really help too. You know, so it continues to be a building block, I would say, as we keep saying in transfer pricing, right? Transfer pricing documentation is important, but to look at it beyond compliance to dispute resolution.
Manisha, you brought two very interesting points. The first thing is that documentation should speak for itself, and you should have the backup for every number mentioned in the documentation, you know, available at the same time, so that you don't go hunting for it when you are questioned on it. And the next thing which you spoke about is that the taxpayer, you know, kind of lagging behind the tax officer or the government's speed on data collation, gathering, and analysis. So, Sanjay sir, would you want to share your thoughts on this particular aspect of the tax department being ahead of for a change?
Yes, Ketan, they have certainly, and thanks to BEPS, because a large amount of data was moving in. But I suppose the journey started some time ago. The journey started when they started looking at their domestic information, also how the best they utilize it, and largely not only for the transfer pricing, but also for the the normal corporate tax issues. And BEPS, CBCR, master file, the kind of data which has started coming in, that has really put them onto a different level. So today, most of I will not only talk about the India, but also I saw it in the UK HMRC. I saw, discussed this with some of the African countries, because, when I visited places like Kenya and Rwanda, they are also putting a lot more data into the system and trying to work around or develop their risk assessment system. Now, what is this risk assessment system? And Manisha did point out that, which is a very, very important aspect. It's not about only that you will, there are topics like intra-group services, coming to the transfer pricing domain, royalty payments. Many governments think that to be a tax-based eroding payments, and they tend to develop some kind of risk tools to capture whether this is, is it an outlier for that company vis-a-vis the general market trend, or is that something which is in line with the market trend? Because ultimately, it is the transfer pricing, risk determination, or anything is based on the comparability analysis. So the risk, and that can be done at the taxpayers level also, to start looking at what are those risks, which are the payments which are going to be. We are also, while we are concentrating on the international payment, one has to be mindful of the domestic transfer pricing issues also, because subvention, something which we are quite aware that ATIA and many of the area exemptions and various other deductions and exemptions did run into problem at some point of time, and there were certain investigations and certain reports came out, and there have been large number of economic reports also, which talk about some aspects of whether they were being used versus misused. So all these are, I mean, the tax department, when it looks at all these things, they are not away from this. There is no wall which stops such information, and they look at all those informations to determine the tax assessment. So tax risk assessment. So risk is a very wide tool. It is based on a lot of information, a lot of intelligence, and then the analysis. So, and that is something which the taxpayers, either they do themselves or with in a group, or they either the industry associations do, but something like that, they will have to do that. First analysis they will have to do, otherwise, because, and Manisha did point out that that governments will look for the audits but I would want to also mention here that the audit contributes a very small sum of the overall revenue, but it has a very salutary impact on the voluntary compliance, and that is what the audit's main job is, and that is where they would want to continue with the overall thrust of the faceless assessment that they have brought, which is only for the audit purposes, is they want to pick up the cases, audit it properly, make sure that the cases which have a high risk get caught in their net, and they are discussed. They're trying to improve through the technical review. They're trying to improve through the verification unit, etc., which has not been functional according to me as yet. Because I was on another web call some time back, and they did something like this came out. So I would say, but in the years to come, all these will get spruced up. They will get, you will have a lot more things happening, and that will improve the quality of the audit. So we need to brace ourselves accordingly.
Now my next question is to both the panelists, and if I can go with you, Sanjay sir, first. Sir, recently a very, the government came up with some guidelines on MAP, and so do you have any particular instances or thoughts on that guideline document on the map?
Certainly, Ketan, and that is something which I would want to say. Either any of the associations or ICF, they need to take up that the present map closure time is close to about 36 months also, which is a very, very long time, which seems to be, completely, I know some other tax jurisdictions also have similar ones, but talking about India, it's 36 months is almost like 3 years from the time you file that. It's a very large number. And I was also looking at the data that how many cases are pending with MAP. It's close to about 900 or 15 cases or so. And large number of them are transfer pricing cases, and about 125, 126 cases are the other treaty issues. So the idea is that and you have two joint secretaries, two competent authorities to look into those MAP cases. They have definitely improved on the capacity which was there a few years ago. But I suppose that the time to close the MAP has to be reduced, and that is something which has to be brought at least in the first instance to 24, and then subsequently to further lower down, because 36 months is a very long time, and creates a little bit of anxiety in the minds of the taxpayer, because they would want to close this and they do not really see the benefit which they would expect from a MAP thing, having gone there for the double taxation relief. The other one is consultation with the taxpayers have been allowed, and that approach also has to be far more inclusive, and that consultation process has to be brought to the next level, and which has to be in terms of not looking at whether something could be done beyond the audit process, because many times in the audit, and Ketan, you know better than any of us, is not the best position that comes out, and of course that the taxpayer, once the ITAT judgment comes out, then the CBDT has a rule, that's what is there in the new guideline, that they would not rework that whatever has come out from the ITAT. That means that position gets solidified. I would also want to mention here that while I do respect the rulings which have come out from, or the resolutions which come out with ITAT, and it is the final fact-finding authority as it is turning out in the Indian appellate system, I would still say that not lowering the income, in a dispute, and if that is the ruling of the ITAT, but if the tax, the two country representatives in the tax treaty think of that there can be a reduction in or the lowering of the income, can that be done? Because that is a central question. Otherwise, the benefit of the MAP is somewhat limited and somewhat muted, I would say. And I think Karnataka High Court has admitted a writ petition on that very recently, and I would be waiting for what the judgment comes out, because that will definitely throw some new aspects in that order, and I'll wait with bated breath on that aspect. So these three things are coming to my mind on the MAP guidance, and which is what I would want to think that the government could further improve on the MAP guidelines or MAP resolutions.
Manisha, any thoughts from you on the guidelines?
No, nothing. I think nothing in addition to what Sanjay sir has said. I think that's fairly comprehensive. I would say one is waiting to see how effective it is. That's it. So I don't want to add anything new, Ketan, on that.
Sure. Sanjay sir, my next question is to you. While we've spoken about MAP, which is kind of after the event happens, the next important mechanism of resolution of dispute, specifically for a from a transfer pricing point of view is the advance pricing arrangements. How have you seen it grow from the time it was introduced?
So, I could tell you, Ketan, that government was very careful when the APA was introduced. At that time, I was in the government, and they really took a lot of material from Australia, Canada, US, Japan, and many other countries, which have a far more mature tax jurisdiction. And from those tentative steps of the year 2012 or 11 to now, it has really gone many miles ahead. But the number of the cases which are still pending gives me a little bit of jitters, because the number of cases are close to about 1,000 or so, and about 300 or 350 cases have been resolved. I must say that in the last 1.5 years or so, the MAP process has slowed down a little bit. I would put the blame on the COVID, but it's also while the government is making every effort to get out of this COVID and trying to bring many of these things on the rail and achieve the kind of growth rate that it had prepared itself for to achieve that 5 trillion. I suppose it's very important that even the APA program is fast-tracked a little bit more, because a large number of cases are being in the inventory and not being worked out is something which should not be acceptable to the government. Another point which I would want to, while they have opened 4 offices, 4 commissionerates, it started with 1 commissionerate. Now you have 2 in Delhi, 1 in Mumbai, and 1 in Bengaluru. So but I find that the teams are still very, few. You need to, because if the number of people have got released from the faceless assessment system and it's time to get onto some of these prestigious programs like APA to be far more, the requisite capacity is built in them, because so that they can get out of those applications which have been filed and make it less than 2 years if possible. I'm not talking about bilateral, because in that the other country is also involved, but I'm largely talking about the unilateral, which constitute almost like 80% of the cases, unlike many other jurisdictions like US-IRS or the UK HMRC, because they tend to pick up a cases. The good point of the Indian APA program is they do not say that I will not pick up this case. They do not make any distinction between the bilateral and the unilateral case. So that is a very, very important point. But I am largely on the time that it is taking to resolve the cases. The second one, which I would want to mention here, is that while we do understand that APA program is a very data-intensive program, and I suppose that taxpayers are ready, I would want to mention here that while the tax department should ask for a large amount of data, and the taxpayer must be prepared to provide those data, because otherwise the program is not good, and the trust and transparency is the hallmark of APA, and both the sides have to come together. Important is that many times I find that approach tends to be slightly more on the audit side, and that is something has to be shunned, and so that the trust and transparency from both the sides can move to the next level, and the tax department considers that the clients or the taxpayers to be partners in this particular thing, because it is giving a lot of certainty. The taxes which otherwise were getting into dispute are being paid by the taxpayer in a without any difficulty, because ultimately you negotiate, and if it is agreeable to both the parties, then you sign on the agreement, and then you pay the taxes. So the compliances, etc., are far more easier, and the amount of the benefit it does bring for the future or the potential investors in the country is humongous. People really appreciate. I must also say that, Ketan, that there have been APA cases which, and particularly unilateral, which have got resolved in 11 months also. And the reason for that was that the taxpayer was giving data to the consultant in a seamless manner and in a double quick time. But there have been also another set of cases where large number of taxpayers that did not give the data. They take very long time. They question what the data is going to be used for. So while I see the little bit of difficulty from the taxpayer side, I also see a little bit of a step forward that the tax department has to go to resolve that and bring more trust and transparency on this aspect. I know it took a little longer than I should have.
No, sir. It's always better to have detailed perspective. Manisha, my next question to you is that, we have seen cases getting resolved pursuant to an APA, but what goes behind this glamorous event of signing the APA? Can you shed some thoughts on it, specifically on the condition, the considerations which a corporate goes through, or which it finds relevant while making a decision of pursuing an APA? And what goes behind the preparation for an APA within the organization?
Right. Thanks, Ketan. And I think, taking a cue from what Sanjay sir said, it is meant to provide certainty. So it is very, very enticing that we look at, that an APA can be a solution to a potential issue. So now, having said that, it is a real decision. If you look at it from a company perspective, it is a real decision. And when I say it's a real, as in it involves multiple facets before you say, okay, I'm going to go for an APA in that particular country for that particular transaction, is a decision that's not taken lightly. Together with your fairly senior tax people and the business folks and the CFOs. And why is that the case? We are talking about really long timelines over here, right? You are going to begin an APA that's going to be over the next 2 years, 3 years, 4 years, whatever it takes to get that resolved. We are also talking about significant investment in both time and money. APAs are not inexpensive affair. Now, having said that, you start and you begin with a business case document, right? To say, what is the business case of doing an APA? And very quickly, the easier ones is, at what stage of litigation are you on? Are you anticipating? In which case, certainly APA is a consideration. Are you anticipating a dispute? Or are you in a dispute already? In which case, the map and the other, matters, the courts are the thing. What are the costs involved? I mean, when we begin with the business case consideration, you're talking about, if you're in an MAP, I mean, assuming you don't do an APA, and you let the matter go and say, we will resolve it when the dispute comes up, you're going to have experts who will have to be hired. We see testimonies being given in advanced transfer pricing cases. You need to pay external counsels, documentation that needs to be generated, external fees that needs to be paid, and the time it takes to resolve that. So either way, what we find is that depending on what stage of dispute that you're on, certainly APA or MAP is a consideration. That's a decision. So very often, Ketan, you're asked a question, hey, we can resolve this through MAP, right? Let's do this today. And we'll look at it at an MAP to say, no, are you expecting an examination in an audit in the next 1 year or 2 years? Or is it, is it already on? In which case you may have spent, the examination, you would have spent all that money already. versus no, I'm not expecting an exam or an audit in the next 1 or 2 years, then, then look at an APA. So it is a discussion that goes on, as it's an investment of time and money. The other points I would put is, of course, you look at whether the matter is fit for a unilateral APA, what is that country's experience, speed, the other matters that Mr. Sanjay has already talked about, right? And then you also talk about nowadays, Ketan, I want to bring out this point, is the impact of negotiating an APA in a country, in other countries. So in the master file, you're supposed to disclose which APAs you already have. And what is the, so if you come up, what is the final position going to be? You agree to one position in one country, what impact does it have on the other countries now going forward on that model? That's certainly a discussion that we have. What impact will this APA or the outcome that we are anticipating out of the APA have on prior year's assessment? Because these are, the businesses have been on for a while. And lastly, you may discuss about indirect taxes. Does it have a customs issue and other indirect taxes in the country? So you need to get together to take this APA discussion beyond just the cost, but the what it will do to the ecosystem, if you will. Even a large company will not have more than 1 or 2 APAs running simultaneously. So, but the audits are on across the world. So you pick your battles kind of a thing, over a period of time. The 2 points, additional points, Ketan, that I'll make over here, that especially on matters of intellectual property and royalty, confidentiality of what you're going to share continues to be a concern. That's a matter you need to discuss with legal to say how much can we share. For manufacturing companies, a lot of that is in form of know-how, non-registered IP, so trade secrets and things. So how do we sort of, position that? What can be shared? What cannot be shared? And the spirit of transparency is there. I think the biggest draw of an APA is that you are in the process. Unlike an MAP where you hand over your facts to the taxing authorities, the competent authorities, and then they take it from there. In APA, you're actively involved. So, I think from a taxpayer perspective, we certainly look for transparency. But how far can we go without breaching our confidentiality norms and and all that is again a discussion. So a lot of work goes on, Ketan, before you make a decision for an APA and put your stake on it to say we will do it. What really helps for somebody who's an in-house practitioner is to build, and particularly in these COVID times, is to build a business case within the business. And it's not easy, while we as tax people will agree, wonderful, APA is the best way to go on this, it's hard to convince your stakeholders that that is the way to go. On an average, it can cost you anywhere between $700,000 to $1 million to do an APA, right? And you are talking about, and I'm talking about the entire fee structure of a bilateral APA. You've got 2 sides, counsels involved and all that. When we draw up the business cases, we certainly look at an immediate cash tax impact that it can have. Can it have some business disruption, stopping and all that? So you try to kind of rally and find your allies in the key issues that are related to this. So for example, these days, cash tax is the big one. So you say, okay, I can do this APA that's going to help me, not pay taxes every year or something. So finding your specific trigger point that will get you to approve the APA is still a journey in-house, even if it is the right thing to do. So that has been our experience. Otherwise, you can say, well, I'll hire 1 or 2 people who will continue to give the documentation versus sort of taking it to say, no, I want to get into an APA and be transparent and solve it for once today, which is getting harder and harder. So you need to have some persuasive skills and be close to the business to understand how it impacts the ongoing goals of the business as well. Like that. So that's broadly, Ketan, is what goes on behind it. A lot of it, I can say, a lot of discussion. So if the APA itself is 2-3 year process, I would say it would be a 6 months process before someone actually approves and says, okay, you can go to an APA, if not longer, while it goes through the chain of approvals.
Manisha, my next question would be to you. have you experienced any turbulence midway through an APA or post an APA? And this question may not be strictly to your Indian APA experience, or maybe if you have had some experience on global APAs also, if you want to share some experience with the audience.
I think it's not so much about the turbulence. I think it's certainly once you file an APA, different countries respond a little bit differently, Ketan. Some countries won't even accept an APA until you've given a fair amount of details to be admitted into the APA program. So you are, even before you have entered an APA program, you are preparing the volumes of documentation that should have been as a part of the APA process upfront. So we've seen that as an experience, and others, there is certainly give me this data, give me that data, that thing goes on. And I think Sanjay sir talked about that the taxpayer needs to be prepared for it. It's yet a humongous task. Whether we, to directly to your question, whether we got a result that we didn't like, and it's so turbulent that we went into it thinking that we'll get something else if we got, well, not so much. I think in the APA, you get a chance to discuss. And look, you do go into countries, you specifically pick up the countries to go for an APA where you feel that the position will not be what you expect sometimes, right? Either the transaction's too big, so you want to hedge your risk, or you think that there may be an altogether different viewpoint that the tax authority will take, and therefore I want to go into an APA program upfront. So I have not seen a lot of turbulence. More recently, we were asked by our advisors of whether the outcome that the APA authorities may come out with still works for us under the COVID profits. And we responded it by saying, well, we will use the comparable data. That's because we were at a stage in an APA where the new comparable data of COVID is still coming out. So when we are heard, we would still like to use the global comparable data that should show the COVID impact. So things like this have been coming up broadly, and then we are responding to it based on what based on what we are seeing, from a economics perspective.
Yes, sir.
Ketan, another question which I would want to, I can ask if you permit me to,
Sure, sir.
Manisha. Manisha, how about the post APA? Because many times the critical assumptions, which are very important, and how well do you prepare for that? Because that I many times find at times gets into the wrong side and can create a little bit of anxiety to the taxpayer. So how would you prepare for that?
No, certainly, sir. So if you think of it, the timelines, the critical assumptions, the disclosure you'll make in the APA, the coverage, all of that is an item that is enshrined, right? When you go into an APA. And that's the discussion. When it comes to critical assumption, a lot of that is with the business folks. It's with our business structure, right? It's with our business teams to say, we will operate under this commercial structure for the next 5 years, 7 years, and that's not an easy one to look. The businesses are organic, so they are taking decisions as we speak. So when we elevate, particularly for an oil and gas company, we are also responding to carbon credit situation, sustainable energy, what all is going on, beyond our control. But we are responding quite a bit to the supply chain disruptions or the changes that are happening. But certainly, it's a very good point. The reason why an in-house APA decision takes time is because you boil up this to the right set of people within the business and say, here are our critical assumptions. Unless you see, and these are at a CEO level or the head of operations, supply chain, unless you see something dramatically changing, look, it will derail what we have agreed. And if tax has a table, and of course your global tax director is involved, if tax has a place on the table on major supply chain changes that are happening in the company, you can intervene later and say, hey, this will have an impact on our APA in that country. So if that's important enough. So I think it's a very important thing to list down the critical assumptions and take it beyond tax. Even your CFO, but actually to the supply chain teams who may be thinking completely differently, for some kind of consolidation or some other objective. And yes, that continues to, it has come up at least 2 times in my experience, where they say this might have a problem on our critical assumption.
Sir, my next question is to both of you, but I would firstly come to you, Sanjay sir, is that I know you spoke about transparency being a key in entering into an APA. Would you want to quickly list down some specific do's and don'ts of getting into an APA or while negotiating an APA?
So, well, I don't have a laundry list just in front of me, so which I can narrate. But certainly the point of which Manisha picked up is the critical assumption, because I particularly feel that while you are looking to go into the future and you are very quite well on the numbers that you finalize, the companies need to work on the critical assumptions far more, because Manisha did bring this point about the organic growth of the companies and the businesses and multiple issues, because the M&E group would have a number of things, and particularly if it is working on the commodities, something which Manisha took an example like oil and gas industry, or even the other aspects, it's very difficult to predict. And even for a case like distribution or selling or those kind of things, and typical and the tax department largely relies on the taxpayer to give that critical assumption. They are quite amenable to make the change. They are, of course, would want to make sure that if there are 2 parts to the business and one particular business is being fixed at a lower arm's length price or lower PLI, and in the TNMM case, and the other one is being pushed at, so they would only want that there is a transparency in the cost analysis, etc., cost breakup or the cost keys, etc. But critical assumption, according to me, is an economic exercise, and it requires a lot more understanding. And this is where I would want the taxpayers to really put in their head into that. That is something which I would say. CVDT on its own has been, as I have seen, that 2-3 cases have come where the taxpayers have asked for changes, and they have taken a very broad view so far. There was a particular case on which there was no mention of that, and it was an extraordinary cost, and the transfer pricing authority during the annual compliance took this as part of the operating cost, and which in a TNMM situation really enlarged the amount of taxes that the taxpayer would have to do. So inside that case, the taxpayer went to the CBDT, and after a lot of discussion, they came out with something which was very different from what the taxpayer, the TPO, had said. So they have largely, the 2-3 cases that I have in mind, they have taken a very positive view, a very large view, and has made sure that the APA agreements are not disrupted, and that is a very good. But then, it's very important that we do not test the CBDT to the last extent, and make sure that the critical assumptions are well crafted and are not routine. Don't rush into it. Prepare hard for that while you are doing. The second point which I want to mention, and I did mention about the transparency process, and make sure that that most of the data, if it is not something very very critical and for the business, and certainly very confidential, you must give the data to the extent possible. Of course, if there are difficulties, it's better to tell the taxpayer, that the tax department, that I have difficulties in giving this particular data. Because the moment you do not do that, they feel that something is missing between the 2 sides. And that breaks the overall the discussion, and makes it somewhat more difficult, because then it's a cat and mouse game that I'm chasing you to give me them data. It becomes gets into the little bit of audit side rather than a APA side. I would want to avoid that, and that will be certainly my the second suggestion, because if something comes to their view which is very different, it can lead to a APA cancellation, and that could bring all the hard work will go down the drain. Apart from that, you get into the get picked up for the audit as the case would be. Of course, there is no word on that, but I suppose that there will be that the relationship just breaks down. So never do that. If there is a difficulty, by all means, go and tell them that we have difficulty in giving such critical data. I can show you, but I do not want to give you. They may be okay with that, and we have done that in a couple of 2-3 cases. Apart from that, I suppose the most important is, while the APA is filed, the taxpayer should not go to a slumber and say that, okay, when the questions come, I would start preparing for that. We should start doing it side by side, because the questions will come. Many of the questions, because now there are a large number of APAs which have got concluded. There is a lot of experience available. So one can always predict that in such situations, what will be there. And then based on the two-party conversation, which can be simulated within a taxpayer, one should start working on some of the questions. It's like preparing for an exam. Many questions may not come in the exam, but many questions will come. So you will be prepared for that. That will allow you to hasten the process of APA. And I did talk about an example when the APA got concluded within 11 months. And obviously, how did it get concluded in 11 months? Vis-a-vis some cases where it has taken longer. Is the mantra is only one, that the data came very quickly and could be presented to the tax department, and APAs could be concluded.
Manisha, your thoughts on this?
And Sanjay sir, I mean, such important points on being prepared. And I would say, actually, even the advisors have a role to play in the middle. So what I've seen is typically you get an advisor to help you with the APA process, right? As a taxpayer, you've got the tax authority, you've got the taxpayer, you've got the advisors in the middle. Where it has worked very well is the spirit of transparency. Is, you've got a couple of opportunities to have transparency. You've got the pre-lodgement meeting. Some of them are on a name basis or a no-name basis. Particularly the no-name basis is your opportunity to be transparent. Let's just put everything out there. Your name is not even there. I mean, but don't hide it at this stage. Let's talk about the entire business model that's associated to it. And where I have found the greatest value by the advisors is when they write the pre-memo that goes into the pre-meeting in the most punchy fashion, as you can put. It's not a routine PPT with a lot of, the basic stuff, but it's also got the message loud and clear to say, what, this is what we want to know. And particularly when you're going to your own country's taxing authority. So let's take an example. We filed, and I'm drawing upon my international experience, but we filed a pre-lodgement with the US for a US company. So you're really talking about the business interests of a US company in your own taxing jurisdiction for a potential bilateral APA, and you want the APA authorities to work with you to get the desired outcome, right? So the advisors who were working with us, and it was for the first time that I saw, actually trashed the PPT that we had sent across, which perhaps was more audit focused or, very business focused, and say, we need to condense this to 3 pages, very punchy document that says it all, because this is a pre-lodgement meeting. And we have an opportunity to be honest about, to bring it out there. It's not about honest, dishonest, maybe that's too strong a word, but really be very clear, very clear. So I feel that transparency within the constraints of confidentiality and those concerns you get a couple of opportunities, and it does help, particularly in the APA process, to both make it faster as well as come to a conclusion that you want, particularly if you want that taxing authority that to work with you to get the desired result. So yeah, that has been my experience, and the advisors have a role to play, to help that. We don't know how to do it very well. Of course, over years you get an experience, but a standardized approach where you miss something or it doesn't come out fully, to both parties, but bring it together and get it done is great value that can be given.
Yeah, Ketan, can we take some couple of questions from the participants?
Sure, Rakesh.
Okay. So the first question, Manisha, is for you. This is regarding the MAP timelines that were discussed. So yesterday we also had this discussion wherein OECD Pillar 1 and 2 recommended 2 years to close a MAP. Whereas Sanjay sir right now mentioned that there are 900 plus cases pending and it's more than 3 years. So the question is from Mr. Samir Gandhi, who is asking that what is your experience in other countries? And there is a supplemental question which says that what are the top 3 factors that industry considers while going for a MAP or an APA?
Right. So the stated goal of Pillar 1, Pillar 2, as we know, at least to the extent we know till now, was to reduce the tax uncertainty and dispute. So as we analyzed the available information on Pillar 1, Pillar 2, a lot of the fine print is yet to come. It's got a lot of, the communique itself has got a lot of publicity. The details are yet to come. We do expect overall that if the consensus is built the way it is being built, that the controversy should reduce. So, but we are yet to see, as anybody can see, the proof of the the pudding is in when it happens. So I think there's very little experience today, but there's an expectation that it should reduce the controversy. Right. Let me take it further to say, and yesterday Ketan and I were talking, maybe that's a question later, but in the MLI, India has not agreed to binding arbitration, which means that, the MAP, they don't have to agree. Well, all attempts are made to agree. At least what I've seen is that, particularly my experience with the US and the developing taxing authorities is that they try to agree because, it's in the interest of the industry, the trade and everything. Unless there's a significant issue with the relationship between the two countries at the time, which is, beyond tax, but they try to agree. So the 2-year time frame, and then it will go into, an arbitration. There is, so far the experience says that what we have seen is that they try to close it within that time frame to not allow it to go into arbitration. And transfer pricing cases, at least to the extent I'm aware of, and not a lot of it is under arbitration, so far. Will it go under the future? Is that what OECD meant when it was bringing out those arbitration proceedings under the OECD? We will see. But as of now, India has not agreed. It is apparently against, the stated position is against the sovereignty of the country and all that. So, that continues to. So I would say there would be pressure to close the MAP within the time frame, but we will see as time passes and look out for it.
Yeah, and the supplemental question is on the top 3 factors that industry looks currently for going for any APA or MAP.
So we discussed during the course of this discussion, a lot of it, if you think, is a summary of what was being discussed today, which is to say, where are you in the audit procedure? Is it in hindsight? Oh, I should have done this, but guess what? I'm under audit already. Or is it a foresight that you are having to say this will lead to a dispute because I'm doing something so big in terms of dollar value to my business, the risk that I'm putting to the business. So whether you are doing this before the event or after the event itself kind of, defines your options and narrows it down to whether you'll go for an MAP or a court procedure, or whether you look at an APA or a safe harbor kind of things which is before the event itself. And when we look at a transaction in foresight, in particular, to say this is complicated, should we deal with it in MAP or should we do an APA on it? A lot of it is dependent on, I think we discussed on the factors relating to how long will it take, what is the cost of doing it? How many APAs do you have running already? Critical assumptions are grounded or not, or is it too moving? So those discussions internally go on before you come to, a conclusion. But I mean, it is a dynamic. I think almost a summary, Rakesh, of what we've discussed today, right? I mean, the question may have come at the beginning of the session, but hopefully the session kind of, help solidify those moving dots. Yeah.
Absolutely. Second question is for Sanjay sir. Sanjay sir, this is regarding the royalty rate. In the discussion, Manisha ma'am discussed about the IP elements. So what is your experience of dealing with some such royalty at the tax office vis-a-vis APA, vis-a-vis MAP, and whether, the residual profit split has been being considered in any of these scenarios?
Well, Rakesh, royalty is one of the hot topics even in the APA and in the MAP, because the disputes do get raised on the royalty. And I did mention that many country things, and India is certainly one, where they feel that the royalties have to be benefit oriented, and that is what creates the whole dispute at the auditors level. Now, coming to the MAP, etc., then in the MAP is, of course, that there are two sides are looking at it. The draft from the audit side is already available, or the order is already available, and then they start looking at what should be the royalty. So it's up to the discussion between the two countries to what extent the negotiations can bring a comfortable position on either side. One country is allowing the royalty payment to go to the other one. So in one case, it is an expenditure. The other case, it is an income. So they look to bridge that gap. And typically, and I'm without reference to a particular case in mind, it could be between 3 to 4%. It could be 2% also, because what is very important is what are the facts of the matter. Because if the two competent authorities feel that the royalty payments are there is not enough benefit that they perceive, then the payments can be. Talking about the APA, and you talked about the residual royalty, there have been cases where the residual royalty have zoomed to almost like more than 35%. And this will seem to be a very difficult task. But then it was a case where in the authorities did realize, because if I can tell you a little bit of without revealing the name of the case, this was a case which was filed on a cost-plus basis. Then subsequently, what the results on the cost plus will be quite limited, which is what the CBDT resolved it, because the taxpayer said, okay, I have it at cost plus basis. But then the taxpayer had its customers in India. There was a lot of technology available, and those technology were very I should say very specific to the taxpayer, and were developed by the AE, and so they and that was recognized by the taxpayer. So when the taxpayer went back to the CBDT and said that this resolution is not the best, it took a little bit of time for the tax department. And when I said all from after the resolution came to the next resolution which happened, it was about 3 to 4 months. So they really went above. So they were quite open to it, I must say. 3 to 4 months time, so the data were reanalyzed, facts were reestablished, and then the resolution which came was something which I just mentioned. So it all depends on how you present the case, what are the extent of to what extent you could demonstrate the use of technology, what is the benefit that the Indian taxpayer is getting, what is the benefit that the other person is getting. So if you bring all these aspects through the data, I think the resolutions are not, one thing which I would want to say, I have seen a lot of flexibility also, Rakesh, at the end of the tax department. And this was there may be one example that I just gave, but there are a lot more such examples when they have gone that. There are also positions which are far more solidified ones because of the data crunch and the data not coming, and that creates a little bit of roadblock. But so we have both the ends. I cannot give you a definitive response, but I can give you some examples.
Yeah, thank you, Sanjay sir. It's heartening to know that the government is accepting the ground realities and ready to give as high as 35% plus royalty, applying a residual profit split. So that's nice to know. The next question is for Manisha ma'am. This is regarding your comment on shrinking of global profits and the tax transformation that you spoke about. The participant wants to know what are we exactly speaking of, whether it's a temporary or a permanent phenomena of this shrinking of profit, and whether you are thinking of a cash strategy or like a shifting of a method itself. So if you can elaborate more on the tax transformation and global profits.
So when I made a comment on tax transformation, I was talking more on the technology side. Okay. And also the changing trends on e-filings, if you will, of data that's happening, right? So there are different groups that are asking for data. So you've got customs e-filing happening in the Europe, there's intercompany, and it's a starting trend pretty much across all the countries. So if e-filings, your real-time data is going to the tax authorities, how are you coping up, not post facto, but understanding the risk of what's going over there? CBCR is filing pile of data over there, to the tax authority. So when I was talking about tax transformation, it was less in the context of COVID-19, but more of things to come. The directionally as a profession and as a function, where are we moving? And the journey is, and the more tax professionals you talk to, Rakesh, you speak to different companies, you talk to different service providers, you will see that everybody's in a different stage of transformation. So the question is, it's less to do with, it's less to do with, hey, have I got, people are from Excel to bots, so the question is, where are you? And that's a very interesting topic, perhaps for another day, where we should talk about how the days of Excel are surely gone. But even if you're not on the bot, you can still get something done in the middle, and have a plan to align with the rest of the company, if as a function as well in their ERP journey. So that is, to me, is the tax transformation piece. On the COVID-19 and the shrinkages of the profit, that's a real phenomenon. The business is obviously, to stay afloat, is accepting deals and doing business, in at margins that may not have been pre-COVID. It depends on the model itself. If we are signing long-term service agreements that have low margin, the impact will continue for many, many years. If you're talking about the transactional stuff that has happened, which is more one-time sale of the equipment or whatever else, then that's something that will pick up with the industry uptrend. And certainly specific to oil and gas industry, we are seeing that the cycle is picking up. It's very, very cyclical. So we've seen the trends over years, they go up and down. COVID-19, particularly, I think it's good to stay in touch with your advisors to say, what is it happening to my industry? And we've done some real work together with other oil and gas companies to define the impact to oil and gas companies and incorporate that in our TPG. So that's the specific action we've taken, so that we are really talking about bloodbaths that happened with, with COVID-19 and, in the beginning of last year were a lot of oil issues in between Russia and the Middle East. So we are documenting that consistent, in a more organized fashion. So we got an advisor to do that for us, backed up by studies, and incorporate that in our TPD. So we are putting the story of both the business and the industry together.
Yeah, thank you for being transparent on how industry as such is taking positions. And in line with your own thoughts, there is last question. Let's have this. Is saying that, Manisha ma'am mentioned about e-filings, and there is also transparency regarding now the documentation, the 3 CEBs, CBCR filing, then master file, then there is a pillar 1, pillar 2 coming in, which is giving everything to everyone. Now, will this increase litigation or reduce litigation? The question is for all.
Well, I think I'll just say two words, and I think Mr. Sanjay should bring in the perspective from the revenue. Everybody is grappling with how that data will be used. More data is not necessarily more information.
Right.
So when we are talking about filing a lot of data, at the taxpayer end, the thought is, am I filing the same data everywhere? Is the data correct? Is it flowing out of common, correct ERP? Do I need to go and make changes and all that? And I think as we are filing, we are also wondering whether the person who's receiving the data, is going to interpret it and use it in the right way, in the spirit of what it was. So I think a lot of data is flowing, but both at taxpayer and at the tax, and OECD, I think, talks about it and gives guidance to even tax authorities on how to use that data. And so that's from my perspective, but you have to prepare for common sources and fewer errors. So unless you're embedded in the IT, just mere consulting will not help. That is the point I was making. In our profession, I have advised a particular controller or an IT person to do it this way. If it hasn't happened, then you're in trouble. So you have to now embed tax function into technology and get it done, because that's how the data is going to flow now. You're not going to be able to filter a lot of it upfront. It has to come out of your systems. But of course, if Mr. Sanjay wants to add about what tax authority thinks of receiving.
In fact, both sides we want. We also want Ketan to speak from the consultant's perspective.
Oh, yes, absolutely.
And Sanjay Kumar from the department perspective. We have seen the industry perspective from that.
Okay, Rakesh, two bits on that. I am quite sure that with the data flows and data have actually been filed by the taxpayer, they have taken into account and they understand that, and we did talk about that, that data will be used for the audit purposes, will be used for the risk analysis. And once the data is coming from a M&E, and these are big M&Es, they're 750 euros or something, million euros and things like that, turnover, global turnover. So we are looking at a large M&E, and they normally have, very smart tax advisors and tax personnel in them, something like we have Manisha. And they would be quite aware that how the data is going to be used or misused. I don't think it's a misused. Is that data is about going into the right place and getting seeded there. Now, it's a tax department, because he thinks that the data is coming from somewhere and it has something like this, they may raise these questions. The questions could be something which is coming from your own data. I mean, audit, please understand one thing, that tax department does not have any data which is not yours. They pick the data from the taxpayer also only, whatever you're submitting, and then they try and see if is it making a credible explanation based on when they ask the question. And there have been instances when you give a credible response, it seems to be a good one, and the tax department may not take that particular, let's say, transaction or audit. They move to the another one. I mean, I see Ketan already in agreement with me on this particular point. But coming to the pillar 1 and pillar 2, they're not meant for dispute raising. Pillar 2, we already are getting into the global alternative minimum tax, etc., 15%, and most of the countries are going to do that. On pillar 1, they are already trying to work out how the taxes will come between the two countries, and if allocate the residual profit or whatever beyond a limit or something, they will move from there. The mechanism is not yet clear. This is all in the domain. I am not actually aware that even the OECD has a ready-made solution on that. Leave aside the tax departments. Everybody is waiting with the bated breath with something to come out in October 2021, which is another month away or so. So I don't think the dispute will be there. If there are disputes, and I'm putting this point of view, we have moved on this tax harmonization, international tax harmonization, something which the international tax community has been trying to forge since 1945. They have not been successful.
Right.
On the trade side, something like this started with GATT and then moved into the WTO and with a dispute resolution. So presently, the dispute resolution in the WTO is one of the best mechanism that countries have. I'm not suggesting, nor I have the ability or the stature to do that, but there can be a way that they may think of something like this. If that is the tax authorities come to something like this, if a situation like this comes, how do we resolve that? Because in that at that time, these bilateral disputes are not going to work. We need to move towards a multilateral dispute resolution system. And once that set the parameters or guidelines or something like that, I think most of the stuff will happen accordingly. So they are not meant for dispute raising. I would say that we at the moment have a very limited vision on that, but then in the future, in the days to come, this could get expanded.
And thank you, sir. So final take, Ketan, as well as closing remarks, and then I will request Aditya to share the hearty vote of thanks as we are on the top of the hour.
Rakesh, I think Manisha and Sanjay sir both put it appropriately. We are living in a changing times. If you submit data which you are able to explain, the tax authority is going to look at things in the right perspective, and that will be the end to the story. If there is any data which is flowing out from your documentation or from your filings, which is not explainable and which has gaps or loopholes, it would be much more difficult for a taxpayer to defend. So while obviously the litigation may not stop, the litigation will continue, but it will be more difficult to justify or explain the discrepancy. That is what I wanted to put it, to close it in a more simpler terms.
He has answered a typical consultant's answer. So thanks, Ketan, and it was
everyone,
nice.
as you know, Rakesh, everyone has a role to play in this ecosystem, including the consultants. I highly rely on their expertise, actually.
Right. No, absolutely. He has to guard from all sides also and see the interest of the taxpayer as well as the revenue. May I request now Aditya to give the vote of thanks.
Yeah, thanks Rakesh Alsi sir and WRC for giving me an opportunity to present a well-deserved vote of thanks to the panel for their excellent brainstorming session on international tax dispute resolution, the evolving landscape. Mr. Sanjay Kumar, during his deliberation, shared his experience during the time with the government and practical experience also, and the international landscape process being taken on bilateral and unilateral arrangements, BEPS, OECD guidelines, and stress upon that issues due to recent MAP developments and APA and legal framework, and sharing valuable insights that government is also accepting ground realities and how data collection process is being done by the government, and a need to move to multilateral dispute resolution system. CA Manisha Pande shared her international experience and also shared a practical experience on what points based on which you should go for DRP or MAP, and based on factual and current views within the timelines and based on interpretations of law. Further, she stressed that the government is heavily investing in technology and tax transformation is happening very fast. And we have to catch up and gear up and be quick, and also importance of documentation and to decide whether to go for AAP or MAP based on multiple factors as cost effectiveness, timelines. Also, I would like to thank CA Ketan Ved, the moderator for today's session. It felt like since Janmashtami is around the corner, you could charioteer the participants like Lord Krishna did for Arjuna in Mahabharata through very practical questions which one could very well connect with, as these are problems generally faced by all transfer pricing SSCs, and did reveal very interesting facts. And last but not the least, I thank Rakesh Alsi sir for moderating the entire session. and also sharing his thoughts and taking questions from the participants. I would also like to thank WIRC for organizing the refresher course and inviting learned speakers to deliberate on important topics. And I'm pretty sure that precious knowledge shared with them would really help in the future practice. And last but not the least, I will thank all the participants on behalf of WIRC to join in large number and making the refresher course a successful one and taking benefit of the deliberations of the learned speaker. Thank you. Over to Rakesh Alsi, sir.
Thank you. Thank you all. Thanks a lot.
Thank you. Bye-bye.
Goodbye.
Thank you.